Okay, awesome. Thank you very much, Aishwarya. All right, guys. Thanks for sparing time and welcome to this FRM lecture of foundations. We're going to kick this off with foundations today. Just so you're aware, we're going to complete foundations in 2 sessions and then we move on to FMP, which is financial markets and products. We're going to complete that in about 5 sessions. And then we'll move on to valuation and risk models, which we will complete in 4 sessions. Time is not going to be the issue here. We have ample amount of time. And as we end a session, we will also try to cover as many questions as possible. Analyst Prep is the platform that you guys may have been given access to. I'm also going to be using the same in our lectures. I will be sharing my screen as we go along. And all I need you to do is be attentive, ask questions, and try and practice questions as you can over a period of time between classes. And I will try and cover as many good, authentic exam level questions that we get from the question bank. So let's hope that we're able to spare some time for questions. And sparing time for questions will only happen if you guys are attentive and you're able to capture what I'm talking about. I will go slow. And because I understand there are a lot of you here who do not have a past background of risk management. Some of you may even be new to finance, which is absolutely okay. So I'm going to go slow. If you have queries and doubts, please do keep bringing them up. If there are things that I feel are not relevant for the exam, but should still be addressed, I will try to spare time as much as I can to address all your queries, right? On a personal note, feel free to connect with me on LinkedIn. If you have queries, feel free to put them up there as well. I am quite active on LinkedIn and I'll be happy to respond to you there. Of course, on a best efforts basis. I can see that we are 12 participants here, including me and I think 1 member from Zell. That must mean we are about 10 candidates. So can I request all of you to turn your videos on? It's generally more convenient for me to look at a face and then conduct lectures. And I hope that you're going to be comfortable doing that. I will urge you to do it. And also, I'll request each one to just give me a little 15-second introduction. I can see Supreet, who's top left on the screen for me. Supreet, if you can please introduce yourself. Let me know if you're studying, what are you studying, and if you're working, where are you working, and why did you choose FRM?
Good morning, sir. Hi, I'm Supreet. And I'm doing my undergrad, and I think FRM would add value to my profile to go with work in the field of finance. So yeah, that's me.
All right, interesting. All right, Supreet, thank you. Dhriti is next on my screen. Dhriti, if you can unmute yourself, please. Quick introduction, please. Okay, looks like, okay, Yash, would you like to go, please?
Yes, sir. Good morning, one and all. My name is Yash. Presently, I'm studying at NMIMS. I'm in the 2nd year of Bachelor's of Business Administration right now, and that's all.
Welcome, Yash. Thank you for that. Okay, Dhriti, I can see that you are not able to unmute yourself. Can you try doing it now? Okay, looks like you're having some trouble there. Never mind, Dhriti, whenever you're able to unmute yourself, we'll be happy to hear from you. Ronald, I can see you next. Would you like to go?
Good morning, sir. Myself, Ronald Vaishari. I am currently pursuing BBI from KC College and in my last year.
Why FRM?
So just I had a little interest in finance, so I thought it would be better for me.
Okay, fair choice. Thank you. Oh, I can see you next.
Hello. So I just completed my BMS in finance and I'm working in Motilal Oswal as equity advisor.
Fantastic.
And I have completed 2 NISM exams, that is equity derivatives and research analyst.
Good going, oh, good going. What's your total experience?
Work experience, I'm trading in derivatives market since 3 years, but I have very direct experience into the industry. I just joined company via college placement.
I get it. Good stuff. Oh, welcome.
Thank you.
Rishik.
Hi, sir. Good morning.
Hi.
Myself Rashid. I have done my graduation from ACCA college, that is BMS, and I'm currently working with Morningstar as a data research analyst in performance team. As when I work in MRI process, I do the monthly record process. Thank you.
Okay. All right. I lost the last bit there. I think your voice was not clear, but I understand that you're working with Morningstar.
Yes, yes. As a data research analyst
Data
in
research.
performance team.
Very nice. Very nice. Thank you so much, Rashid. All right. Moving along. Aishwarya.
Hi, sir. Hi, everyone. Hi, sir. So I'm Aishwarya. I'm from Bangalore. Currently, I'm working with Diageo India. Like previously, I was working with McKinsey. I'm into auditing and insurance. So I was looking into, the financial risk part, where it could help in my career.
Interesting. Good choice. Aishwarya, welcome. Thank you.
Thank you, sir.
Who's next? Who's next? Tanish. I hope I pronounced your name right.
On the space. This 12 from the
All right.
most background like working experience.
Okay, awesome. Tanish, welcome. Good to have you. Ajinkya. Yeah, that's you. You're on mute, Ajinkya.
Sorry. Hi, sir. Good morning to one and all. My name is Ajinkya, and I have just completed my MCOM last year, and trying FRM because I got through the material and the course, and I find it very suitable to my career style and the way I want it. That's why I adopted it.
All right. That's pretty good, Ajinkya. Thank you.
Thank you.
Saurabh.
Hello. Am I audible, sir?
Yeah, I can hear you.
Yeah. Good morning, sir and one and all present. I'm Saurabh. I've completed my bachelor's and post-graduation into finance and banking. Why FRM? Because finance and risk management interests me a lot. And looking forward to work into into risk management. And I have a work experience close to 3 years. And I'm currently not working. I'm currently searching for work.
I see, Saurabh. Okay, that's very interesting. I hope FRM helps you there. But your 3 years experience, where is that with?
Actually, I have a diverse career, and I was into accounting, I was into operations, I was into auditing, like that. Yeah.
Interesting. So I think I'm expecting you to bring a lot of your auditing, views and marry that with risk management that we're going to talk about here. Okay, Saurabh?
Sure. That would be great.
Yes.
Looking
Welcome.
forward to contribute.
Yep. Welcome. The last one on my screen is Anshu, and then I'm going to request Dhriti to try and unmute yourself again. So Anshu, over to you.
Hello, sir. Good morning.
Hi.
I'm myself Anshu Kottulwar from Maharashtra, Chandrapur, Maharashtra. Currently, I passed out 12th class.
Okay, Anshu. Yeah, good to have you here. All the best.
Thank you, sir.
Okay, Dhriti is the only one left. Yep, I think you're able to unmute. Go on.
Good morning, sir. I'm from Jaipur, Rajasthan. Currently pursuing bachelor's in financial marketing in Mumbai, KC College, and I'm a second-year student. And I have an interest in markets and all risk management. So I would like to go with financial risk management.
Okay, great choice, Dhriti. Good to have you here. All right, guys, thank you very much. And again, I'll request all of you to turn your videos on if you can, not just now, but also for the extent of all our sessions. It's always nice to have faces, that I'm looking at when I'm conducting these sessions. Thanks for taking time out for the introductions. I can see that we have quite a diverse, group here from various places in India, as well as from different backgrounds. Some of you have work experience, some of you don't. Some of you have been trading derivatives, which is very impressive. And then there are others who are working with Morningstar, etc. So I must say there's a good diversity here. I expect each of you to bring your ideas, your value addition here. Share your thoughts. Feel free, guys. I want to encourage you to the extent that you should know there is nothing that you can say which is wrong here in these sessions. If I ask you a question, you get it wrong, it's all right. Okay, because it's better that we get things wrong here in the class than get them wrong on the exam. So I want this to be a dialogue. It cannot be a monologue. Okay. The other thing is, I just want to quickly take a minute and introduce myself. My name is Nikhil Nath. I've been in the industry for 15 years. The first 7 years I was in sales. I worked with a lot of banks, Standard Chartered, HSBC, HDFC, private banking, etc. And then I moved to pre-sales with asset management. And I have been part of the RFP world. RFP stands for request for proposal. I've been part of the RFP world for the next 8 years. So that's 15 years that for me in the industry. I'm prior to where I'm working today, I worked with Goldman Sachs. And before that, I worked with State Street Global Advisors and then with Moody's Analytics before that. So that's 15 years for me. I cleared my CFA in 2015, my CAIA in 2021, my FRM in 2016, and my CIPM, which is Certificate in Investment Performance Measurement, in 2018. I've been taking classes since 2014. So it's almost going to be 9 years now that I've been taking lectures. I must have taken about 500 lectures of FRM and close to 1,000 lectures for CFA by now. I'm very, very passionate about coaching, mentoring, which is why I encourage everyone to connect with me on LinkedIn as well. I'm very happy to mentor you guys in the free time that we can spare for each other. As for FRM, guys, you made a brilliant choice. FRM is the foremost risk management curriculum you're going to find in the industry. All right. The kind of recognition that risk management has made for itself is tremendous. And I think the reason the course is valuable is because it is difficult. Any of you who's fearful of getting into a course which is difficult or you think you may not be able to do, if you have those questions, the course is right for you. Okay, because anything that has value, it is because of the toughness of its nature. If it was very easy, the whole world will be doing it, right? This course involves sacrifice, but it delivers a lot of value. It will deliver a bang for the buck. Okay. In my own personal experience, I was able to change my streams. When I was working with sales, I moved to pre-sales only courtesy FRM. I can assure you that much. You may think that I had done a CFA as well by then, but honestly, CFA is not what helped me crack. It was really my FRM at the time which helped me crack and change my profiles. So those of you who are looking to make a foray into risk management, those of you who are looking to make a change to your line of work, or those of you who are just looking to crack into the finance domain, FRM is the course for you. The good thing about FRM is it's got two parts. If you're able to focus, clear both of those in the first attempt, within 12 months, you can have an FRM certification. And if you have the relevant work experience, you'll also have the title against your name, right? That's all about FRM. If you have more questions about FRM on the go, we will keep addressing those. I can see that we have a few others who've joined. Aryan, can I request you to unmute yourself and just quickly introduce yourself? 15 seconds, let me know what are you doing at this time and why have you chosen FRM?
Good morning, sir.
Hi.
Sir, my name is Aryan. I'm completed my post-graduation diploma from IMC and completed my graduation from IP University. After that, I'm pursuing my job and finance career. I want to focus on more on this. I have to pursue that. That's why I started FRM.
Thank you. Thank you so much. That's a great choice you've made. Thank you. Mridul, over to you then.
Good morning, sir.
Hi.
Myself Mridul Pandey. I'm currently in FY BBA first year. Going to pursue BBA Finance in second year specialization. I have passed my 12th in 2021. Then after that I was pursuing my medical. Then I dropped out from that. Now I'm trying for the finance field.
All right, that's interesting. Thank you so much. Thanks.
Thank you, sir.
Sarthak, quick introduction, please.
So, good morning, sir. I am Sarthak. I've currently passed out my 12th and looking for the graduation.
Okay, guys, great. Thank you so much, Sarthak. Thanks a ton, guys. I think we've covered everyone. In case we haven't, we'll find time to do that. Let's just quickly go over to foundations and kick this off. So like I said, we're going to cover foundations in 2 lectures, and hopefully we'll have time to cover some questions as well. First, before we get into foundations, I want to ask you guys, and I'm going to open this to everybody. What do you understand from risk?
Deviation from the outcome.
Deviation from the outcome. Okay. I'm
Expected
assuming
outcome.
expected or the desired outcome. Okay. All right. Anybody else? What is risk?
Uncertainty.
Risk is uncertainty. Okay. I think you attended that 1 hour webinar where I defined it as uncertainty. Yeah, not bad. Pretty good. Yes. Guys, risk.
Uncertainty when you have invested in company which has a financial loss and what we expect from the.
Yes, that's fair. Yeah. Although, yeah, Rishik, although your voice is very faint, but I was able to hear what you said. It's uncertainty which involves financial loss, right?
Yes, sir.
Correct. Yes, guys, that's absolutely right. Risk simply means uncertainty. When you're looking at it from a financial perspective, risk means uncertainty. The moment you're able to reduce uncertainty, you're essentially taking care of risk. Risk appears in various forms, and you're not really able to eliminate risk. Okay, you will have to find a way to manage risk. And over the course of our lectures, you'll find me using the word managing risk very often because risk is managed. And what do I mean by managing? Just as an example, you can avoid risk. So if you think that there is a certain portfolio or a trade that brings with it a lot of risk, you can avoid it. Okay, if you don't create that portfolio, if you don't invest in those assets, you can avoid that risk. You can transfer risk. How do you transfer risk? By buying insurance. You've transferred risk from your own self to the insurance company, right? So that way you've transferred risk. These are ways of managing, and there are a few other things that you can do to manage risk, but you're not really able to eliminate risk. And we'll come to the why of it. Why is it that we cannot eliminate risk? Hedging is also a way of managing risk. So can I just ask you a question, guys? Have you all got your access to the analyst prep?
Yes.
Yes, sir.
Yeah?
Yes, sir.
Okay. Awesome. So we're going to be, yes, great. I'm going to be treating analyst prep as the base for our studies. All right, analyst prep, and I've seen their notes. I've seen the questions. I must say it's really high quality. So you guys have been given access to analyst prep by Zell, which I think is a very good representation of the exam. Okay, so make the most of this. There are different types of risks. The first one is what is called market risk, the most common type of risk. Anybody? What is a market risk?
It is based on the current market price or the situation which market faces, the ups and downs.
Yes, correct. Market risk essentially is price risk. Okay, the risk that the markets introduce into a portfolio, which means that there could be heightened volatility in prices, is called market risk. What is interest rate risk?
The fluctuations in the interest rate due to the internal or external factors like RBI increasing or decreasing the repo and reverse repo rates, which can lead to borrowing with a higher interest to corporate companies.
Okay, yeah, that's a very good point, Ajinkya. Interest rate risk, how does it lend any sort of risk to fixed income or debt portfolios that hold debt securities?
It can affect them when it's inflation, maybe, because if the interest rate doesn't go high with the inflation, the debtor will be in loss. If I'm not wrong.
Okay, partially, but that's not what I was looking for. Anybody else?
If the person is not able to pay the debt, that's the risk.
Okay, so you're saying interest rates go up, and by virtue of that, your interest payments go up, and you're not able to service that interest. Okay, fair enough. Put yourself in the shoes of an investor. Okay, you're an investor. You've invested in bonds. Okay, you invested in certain corporate bonds and Government of India bonds. You've created a portfolio of bonds, and you've invested in that. Interest rates go up. How is it a risk on your portfolio?
So actually there's an inverse relationship between interest rate and bonds. So if the interest rate goes up, the prices of the bonds will go down, which will be a negative thing for me in the short term, as in the long term, the prices of the bond will retain themselves.
Yes, that's absolutely right. For others, you may not know the concept of bond prices being inversely related to interest rates, which is absolutely okay. We're going to cover all of that in detail. But the answer that you've given is correct. Bond prices are inversely related with interest rates. When interest rates go up, bond prices will tend to fall. If you're holding a portfolio which comprises of bonds and interest rates in the markets go up, the bonds in your portfolio will tend to fall in value. As a result, your portfolio will fall in value, right? So that's called interest rate risk from an investor's perspective. If you would have noticed in the Indian context as well as globally at this time in the last 3 years since COVID, we've had interest rates being hiked. Correct? Interest rates have been increased in order to essentially counter inflation. Correct? However, because interest rates have been increased, the idea is to counter inflation, but because of interest rate increases, bonds and debt portfolios have seen a fall in their values. As a result, you'll find a lot of bonds in the markets are available today at a deep discount. A lot of investors who believe interest rates will not be hiked anymore from here and will be reduced in the future are suggesting that we should buy bonds, because bonds that have in the last 2-3 years fallen in value, when interest rates start to fall, they will rise in value. So bonds are good investments at this time. This is what is being purported by a lot of experts. Okay, we'll move along from interest rate risk. Equity price risk simply suggests, the risk that equity prices will be volatile and they'll move around. Foreign exchange risk. Anyone?
The risk associated with depreciation and appreciation of currencies.
Yes, and it is a risk because you may have foreign currency exposure. For example, if you're working with Infosys tends to derive a large chunk of its revenue in US dollars because its services are being utilized in the US and it's receiving revenues in US. It knows today how much USD it will receive at the end of the project in the future, but it does not know at what exchange rate will they convert that USD into INR, right? So that uncertainty of what rate in the future will apply for the conversions of foreign currency introduces foreign exchange risk. Credit risk. So credit risk has so far been misunderstood. It has been understood as being only the risk of default. Okay. Credit risk is risk of default. For example, if you lend money to somebody, or let's say a company, and that company is then reclassified as junk, it clearly means that there is a risk of default, which means there is a potential credit risk. But credit risk is also what is called a downgrade risk. If you lend to a company which was AAA rated, there's a AAA rated company that borrowed money from you and you said, oh, it's AAA, my money is safe, I'll definitely get my money back. But over the course of time, it got downgraded from, let's say, a AAA to CCC. So that company has got downgraded from AAA to CCC. That also is a credit risk because the company has been downgraded. So a company which is facing bankruptcy, or a company that is that's not able to return its dues, or a company that is getting downgraded, right? All of these comprise credit risk. Credit risk is not just a company that's failing or that is going bankrupt. Yes, Anshu, feel free to unmute yourself. I think you have a question.
Sir, what is derivatives?
Okay, that's a good question, Anshu. I could go on for 2 hours answering that question. We'll come to derivatives in detail, but because you've asked, derivative is any instrument or a security which derives its value from another asset. Okay. For example, I don't know if you've heard of call options. Call options are options which have underlying assets. Call options derive their value from the underlying asset. As a result, a call option is a derivative because it derives its value from another asset. You also have futures and forward contracts, which are also derivatives. You have another kind of derivative, which is called a swap. All of them derive their value from another asset. A call option in isolation does not really have value of its own. It derives value from the underlying asset. That is why they're called derivatives, right? I'm going to leave it at that. Derivatives is a huge field. We're going to discuss derivatives in extreme detail. By the way, I think that's a good question you asked, Anshu, because you touched on the topic of derivatives. I will add almost 60 to 70% of your FRM curriculum deals with derivatives, because derivatives are used to manage risk really well. They are cheap and they are used as hedges. So all of you should be very careful about the topic of derivatives when we enter that, okay?
Okay, sir. Thank you.
All right, moving along. Liquidity risk, guys. What do you understand by that?
So I have one question.
Yes, Midhu.
So can you please elaborate what are the bonds and what is different between bonds and securities?
Yeah, sure. Even though I was going to come to that, Midhu, but since you've asked, I will touch upon that. So if you're an investor, there are two types of investments that you can really invest in. One is equity, wherein you're buying a share of a company. So if you invest in equity of, let's say, Tata Consultancy Services, TCS, which is listed on the exchange, what you're effectively doing is you're buying a share of the company and you become part owner in the company. So when the company does well, it earns profits, it returns some money to you, or the share value goes up, and that's how you make your money, through appreciation of the shares. The other form of investment is where you're lending your money to a company. Okay. So what happens here is that's called debt. It's also called fixed income. Why is it called fixed income? Is because when you're lending your money to a company, the company is going to give a fixed return to you on a periodic basis. A bond. So when you buy a bond, what is a bond? A company issues a bond to raise money from the market. So you give money to the company gives you a bond against that. And for the bond that you hold, you are told by the company that you are going to be paid a certain fixed coupon or a fixed interest every year. That's usually how a bond works. You can also be paid interest every 6 months. You could be paid interest every 3 months. But the most common scenario is for a bond to pay annual interest. So these are the two very basic differences between equity and fixed income. As you can see, fixed income tends to have lower risk because the values don't fluctuate too much of a bond. Plus, the company is obliged to return you the principal at the end of the maturity. So throughout the term, you get your interest, and then towards the end of the term, you get your maturity principal back. Let me do one thing. I'm going to share my screen. Okay, if you can see the whiteboard, guys. So let us say we're talking about a bond which ranges from 0 to 10 years. You bought the bond here at T0. You're going to be paid interest at every yearly interval. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, correct? So you're going to be paid interest at each of these intervals. And at the end of maturity of the bond, you're going to be paid the face value back. The face value is, usually 100 or 1,000 or 100,000, etc., etc. Essentially, people say that you get your principal back. It's technically not the principal, it's the face value of the bond that you get back on maturity. And then you get interest paid at each of these tenures. That's the example of a debt or a fixed income instrument, in this case, a bond. All right. Now, there are different types of bonds as well. There are bonds that mature in 3 years. There are bonds that mature in 5 years. And then there are bonds that mature in 10 years. There are some Government of India bonds that mature in 30 years. So there are different types of bonds. Depending on the length of maturity, the interest rate risk also varies. Okay, I will come to that later. But generally, when the bond has a longer maturity, it is more sensitive to interest rate changes. When a bond has a short maturity, it is not very sensitive to interest rate changes. We'll come to the why of that later. That's a topic that will come later when we do our financial markets and products. Okay, I hope that answers your question.
Thank you.
Okay, guys, liquidity risk. What do you understand from liquidity risk? Anybody?
Liquidity risk means when a company does not have enough cash to pay the debt.
I'm sorry, Tanish, I was not able to follow you. Come again, please.
Liquidity risk means when a company does not have enough cash to pay off the.
I'm sorry, Tanish. I don't know, but your voice does not seem to be very clear. Is it just me, or others could hear him fine and I could not?
It's a bit.
not getting the fair value of the assets selling in the market.
Okay, never mind. I'll open this to anybody else. Liquidity risk.
So not getting the fair value of an asset selling in the market for paying out the debts.
Not getting a fair value for an asset in the market. Okay.
While selling.
Why will that be related to liquidity?
If company is not able to pay its debt, it start liquidating, selling its asset in the market.
Okay. Okay. Fair point. Anybody else?
When a company does not have enough holdings of cash or cash equivalents, which they are not able to pay off their debts.
Okay, correct. So guys, by the way, thanks for your views. I think you guys were all right. When we talk about liquidity, guys, essentially what we're talking about is short-term obligations. If a company does not have sufficient funds to meet its short-term obligations, it is in a liquidity crisis, right? So when a company is not able to roll over contracts, when a company needs cash or needs overnight borrowing, it is not able to get that overnight borrowing. When a company has got a margin call, you may not know what a margin call is. I will come to that later. But when a company gets a margin call, the company is expected to bring fresh funds. If the company is not able to bring fresh funds, then the company is set to face a liquidity crisis. Okay, that's all liquidity risk. So yes, you are right. Because of liquidity risk, if there is not enough liquidity in the market, sometimes assets are not priced correctly. Why are assets not priced correctly sometimes? It happens because when there is liquidity in the markets, there is enough buying and selling happening in the markets. When there is enough buying and selling happening in the markets, then the price discovery is happening very frequently. So with markets that are very liquid, the prices are very recent and the prices reflect reality. But when the markets are illiquid, there is not enough buying selling happening, which means there is not sufficient price discovery happening. For example, you may have noticed that with real estate, have you noticed with physical real estate, if there is a piece of property that has not been bought or sold for, let's say, 20 years, there tends to be a lot of vagueness in its price. That's because the last time the property was sold was 20 years back. Now it is up for negotiation that in 20 years, how much has the value of the property appreciated? Compare that with the same property. If it was sold last year, you have an anchor point to start your negotiations from, because the price discovery happened last year compared to the price discovery happening 20 years back. So the more frequently the price discovery is happening, the more accurate the price is. And that essentially is liquidity risk. When there is less liquidity in the markets, there is not enough trading on assets. As a result, the prices don't reflect their reality. The other form of liquidity risk is where a firm does not have sufficient liquidity to meet its obligations. And when it tries to borrow funds from the market refuses to lend funds. Liquidity risk was a very, very major cause for the collapse of a lot of firms in the 2007-9 crisis, including the Lehman Brothers. Lehman Brothers largely collapsed because of a liquidity risk. It was not, liquidity concerns were, that last nail in the coffin. Of course, Lehman had many other concerns, but the final nail that went in the coffin was because of the liquidity crunch. We'll come to that later, guys. Okay, operational risk.
It refers to companies' operational failure, like management crisis, or not analyzing the risk before it comes.
Okay, operational failure. But we need to understand, what do we mean by an operational failure? Anybody?
If company fails to manage.
To manage day-to-day business activities relating to the sales or the profit which they are earning.
Okay.
As an example.
All right. Somewhat accurate. So guys,
Sir,
let's go on.
We can say that the risk in IT companies is the technology.
The risk that IT companies face with technology. Are you saying that's operational? That's not operational risk, and I'll tell you a little later. Anshu says Anshu, do you want to answer that? Please feel free to
Yes,
answer
sir.
that.
Risks of risks of losses affecting to business operational through failed process, system or events, policies.
Yes, that's absolutely right. Correct. Yes. Tanish says it can happen due to employee error. Yes, absolutely. Okay, so that those last few responses were very, very accurate, guys. Operational risk is the risk that arises due to human errors. Okay. Let's say you're a trader. I think one of us is a trader, derivative trader. You know something called a fat finger loss. You're supposed to press 800, you pressed 700. You inputted the wrong order. That's an operational risk. It's an operational error. You know, very often we deal with companies where employees come back and say, customer care comes back and says, sorry, sir, this is a mistake at our end. There was an incorrect entry that was made. We're going to fix it, right? It often happens with banks as well. These are human errors. These are called operational errors, right? So one of the ways for you to identify an operational error is if it is a human caused error, it will be an operational error. The other thing is if it happens because if there's a risk event that happens because of failed systems, processes, those are also called operational errors. For example, let's say a bank finds that its servers are down. It's not able to service customers because the servers are down. What kind of a risk is that? The bank faces loss because of that, right? That risk is operational risk. So that's operational risk for you. Business risk is simply the risk that any business faces. So you come out with a product in the market and the product gets rejected by the market. It's plain simple business risk. What is a strategic risk? Strategic risk is when you, let's say you have your own company and you make some strategic decisions, merger, acquisition, etc. You know, you decide that you're going to invest money in certain projects, divest from certain projects, you're going to merge and acquire certain companies. These are strategic decisions that you've made. And these strategic decisions carry strategic risks, right? So that's a strategic risk. The next is a reputational risk. Reputational risk is, as the name suggests, a company finds it very important to ensure that it carries a positive reputation in the market. For a plethora of reasons, a company can lose its reputation, right? For example, if the employees are found to indulge in activities which are not considered correct, it can have a reputational loss. If the CEO of company goes in public and makes untoward, comments which are not acceptable, it can cause a reputational loss. If the company happens to back or sponsor certain products or celebrities who are not popular in the market, it can cause a reputational loss. If a company does not service its debt and defaults, it can cause a reputational loss. So just so you're aware, guys, we've discussed multiple types of risks. Every risk event, it is not necessary will carry only one type of risk with it. A risk event can carry multiple risks. Okay. So, any questions? I'm just going to pause here. Any questions so far?
No, sir.
Okay. So you remember I mentioned right at the start, I said there are ways of managing risk. Okay, we're going to discuss that now. Number one way of managing risk is to avoid risk. You're going to find this in your analyst prep notes as well. The methods of risk management. You're avoiding risk. How do you avoid risk? You simply don't take up positions that carry risk that you do not want to take on. That's called avoiding risk. Another way for you to manage risk is to retain the risk. Keep the risk. Can anyone give me an example of any company or you in your real life understanding that there is a certain risk with an action, and then you decide that it's all right, I will take on that risk? Anybody, you have an example?
Yes, sir.
Go on.
With my career, I was pursuing my medical and I left. That was a risk for me to join BBA.
That's a great example, Mridul. Yes, absolutely. Absolutely right. So essentially, Mridul, you have in a way managed risk. You were aware of the risk. You said, it's all right, I'm going to take it on. That's another way of managing risk. Managing risk does not necessarily mean that you reduce risk. Accepting risk is also a way of managing risk. Anybody else? So for a few examples, guys. So you know that Samsung is literally a conglomerate which is into multiple businesses, right? Samsung has has manufacturing facilities for various electronic products. It makes televisions, refrigerators, washing machines, mobile phones, etc. Right? Now, electronics divisions for Samsung is a very important driver of revenue. It has now established itself as one of the foremost players in the electronics market. Now, a very big risk that Samsung faces is the fact that it is a very competitive space. If Samsung arrives at the understanding that mobile handsets is a very competitive space and there is not much profit to be made because there are so many other players with such competitive offerings, should we stop making mobile handsets? Should we exit that market? Now, this is a question that Samsung faces. What does Samsung say? No, you know what? It is a risk, but we'll take it on. I think we are well placed to handle that risk. We have an existing facility, we have existing infrastructure, we have good distribution systems, we have developed a good brand, and we have loyal customers who only switch from one Samsung to another. So let's just continue the mobile handset business. What has Samsung done effectively? It has decided to retain the risk. So remember one thing, guys, you retain the risks that you are confident of dealing with. The risks that you're not confident of dealing with are the ones that you decide to mitigate. Mitigate is to reduce, either by insuring, by transferring, right? The risks that you're confident of taking on are the ones that you decide to keep. In other words, you know the word called forte, F-O-R-T-E. Forte means anything that you have a specialization or expertise in. If you have a specialization in a certain field, and if there are risks that come along with that field, you will be confident in taking on those risks. So when a company has a forte in a certain field, the company takes on those risks and retains those risks because the company has expertise in handling those risks. All right. So moving along, what is the next way of managing risk is mitigating the risk. How do you mitigate a risk? To mitigate is to reduce. Mitigate is not eliminate. To mitigate is to reduce. How do you mitigate a risk? A very small example of mitigating risk is to hedge. You may not know yet how put options work, but if you have an equity stock portfolio and you want to hedge that portfolio, what you will do is you will buy certain put options so that when equity portfolio falls in value, your put options gain in value. If you've bought sufficient amount of put options, then the fall in your equity portfolio will exactly match the gain in your put option portfolio. So this is how you're mitigating risk, right? You're reducing risk. And the other is transferring risk. How do you transfer risk? The most commonly found example for transferring risk is buying insurance. So if you feel that there is a certain risk of financial loss that you face for whatever reasons, you buy insurance so that if the loss happens, the insurance company will make good your losses. You're effectively transferring risk. Simple example of a car insurance. You run the risk of loss by way of damage because of an accident. How do you transfer that risk? You buy insurance so that if the damage happens, the financial loss is the company's. You effectively transferred risk. You've not mitigated risk, correct? Because that risk is still there. The damage can still happen. You will mitigate risk if you start driving safely. If you say that I'm not going to go beyond 40, 50 or 60 kilometers an hour, even if I'm on the expressway, I will not go beyond 60, 70. You are mitigating risk there. But transferring risk happens when you buy insurance. Avoiding the risk happens when you decide not to drive the car at all. Correct? That's how you avoid that risk. So anybody with questions on how we manage risk?
So, if I'm having losses in one stock and I'm diversifying the to other stocks, the losses, then can we say that's the transfer of the risk?
So let me let's take an example. Let's say you bought a particular stock. Let's say you bought Reliance Industries, and Reliance Industries has fallen in value. So you're suffering a loss in the stock of Reliance Industries. What do you decide to do now? Do you decide to buy other stocks afresh, or you decide to sell Reliance, book your loss, and then use that money to buy other stocks?
So to sell the stock of Reliance and buy the other stock.
Okay, so effectively what you're doing is you're suffering a loss in the stock of Reliance and you've decided to sell that stock. So what you're effectively doing, in my view, is you're effectively avoiding the risk. Okay, you've already suffered the loss. Now the risk is that you'll suffer further loss. Correct? Because the Reliance stock can keep falling. You've decided to avoid that risk. And how do you avoid that risk? By not holding Reliance at all. If you were confident that Reliance will bounce back, you would decide to continue to hold Reliance. And what would that be? That will be retaining the risk. But by selling Reliance, you've decided to avoid the risk. And by buying other stocks and deciding to hold a more diversified portfolio, you've decided to mitigate your risk. It's not transferring the risk, it is mitigating risk. That is reducing risk. Okay. Transferring risk means the risk of financial loss does not sit with you anymore. So when you have a diversified portfolio, the risk of financial loss is still sitting with you. Correct? Okay. So Anshu has a question on chat. She says, what is the meaning of hedge? If I can explain. Okay, Anshu. So I will try and cover a little bit of hedging since you've asked, although hedging is going to be covered in a lot of detail later on in our curriculum. Hedging simply means that you're finding a way to cover the risk of loss. So let us say you have a portfolio of equity securities. Portfolio of equity securities can potentially fall, right? Because of market movements. What you can do is you can buy put options along with it. Put options will tend to gain value when equity falls. So when equity prices fall, your put option prices go up. Together, when you look at this portfolio of equity plus put options, what you are is hedged. Now you could be partially hedged. You could be completely hedged. That really depends on how many put options have you bought. You may want to partially hedge. Okay, so you could say that, okay, let me buy half the number of put options it needs to be to have a complete hedge. You can say that I just want a partial hedge. So you can be partially hedged by buying those put options. There are multiple other ways for you to hedge, but hedging essentially means that you're trying to recover the loss from an existing position by buying another asset, which is negatively correlated with that. So in this case, equity and put options have an inverse correlation. When equity falls, put options go up. This together becomes a hedged portfolio. So that's largely what is hedging. Okay, I've given you a very, very short and a very brief description of hedging. Hedging is much more complicated than that, but we'll come to that over time. Okay, I don't want to confuse all of you at this stage. Okay, so moving along, there's something called a known risk, and then there are things called unknown risks. So you're going to find this in your analyst prep. There's a little diagram there, which at the bottom says expected loss, and then moving out, it says unexpected loss, and then you have known unknowns, and then you have unknown unknowns. So basically what we're talking about here is, this is a concept in risk management where I'm going to share my screen again. So you have what is called expected loss, and then you have unexpected loss. You have known unknowns and you have unknown unknowns. Expected loss is simply the loss that you expect will happen based on probabilities of default, your exposures, right? That's expected loss. So if you bought a stock portfolio and you're holding that portfolio, you will usually know what is the expected loss. What is the loss that you can expect on that portfolio? Okay, so that's expected loss. Unexpected loss is the loss that happens over and above the expected loss. Okay, that's the surprise loss. So if you were expecting a loss of 10%, the loss happened to be 14%. Unexpected loss will be the loss that is greater than the expected loss. Known unknowns. Now, here's a concept which is also used in psychology, guys. Known unknowns and unknown unknowns. Known unknowns are the things that you know that you don't know. Okay. So today, if you know that there are things that you don't know about, it gets qualified as a known unknown. You know that you do not know about certain things, right? For example, I think it was Anshu who asked me, right? What is a derivative or what is hedging? She didn't know about hedging. It's a known unknown for her. She knows that she does not know about hedging. So that's a known unknown. The next level for that is an unknown unknown. You don't even know what you do not know, right? That's an unknown unknown. The greatest risk in managing losses in the financial markets comes from unknown unknowns. I think I lost my screen share. The greatest risk in financial markets comes from unknown unknowns. Why is that? Because when you do not know what you're not aware of, you're not able to prepare for it. You're not able to manage it. Correct? If you do not know what are the risks that lie ahead, if you do not know what all are the things you don't know about, then everything will be a surprise for you. For example, leading up to COVID, you remember inflation was high. All fund managers were buying assets that are inflation linked, so that with higher inflation, the asset values go up. Commodities are usually a good inflation protection. So all fund managers were buying commodities in their portfolios, right? What was the other risk at the time? The other risk was money supply was very high. Yeah. So a lot of them were buying gold at the time. What is the other risk? Equity prices had already gone up a lot. So what were they doing? They were reducing their allocation to equities. You know, there were a lot of known unknowns. People knew the things that they did not know about. But the greatest unknown was Russia-Ukraine war that, you know, has been carrying on for the last 1.5 years. This was a great unknown. Nobody knew what they did not know about the Russia-Ukraine war. Everybody was preparing for everything else. But what happened in the end? Russia-Ukraine went to war and it affected the markets in a way that we could not even anticipate. So that is an unknown. The greatest risk management challenge comes with the unknown unknowns. If you know what you do not know, decent. But if you do not know what you do not know, you're always going to be taken by surprise. So what you always want to do is you want to move from a state of unknown to known unknown. If you know what you do not know, you're able to manage for it. Correct? And then you have your unexpected loss, and then you have your expected loss. I hope you're clear about the concept. These are just concepts, okay? It's not like one leads to the other. These are just concepts in risk management. Any questions? Okay, I'm assuming no questions at this stage. All right, moving along then. Expected loss is exposure at default, loss given default multiplied by probability of default. And here's our first very important concept for an exam. Expected loss is probability of default into loss given default into exposure at default. Guys, I want you to understand this concept very, very clearly. We're going to be using expected loss concept throughout your level 1 as well as your level 2. So, anybody, can you tell me what is the probability of default?
When a person has taken a loan, for example, for 3 lakhs, but when the time comes to pay the loan to the borrower, to the person who has provided the money, he do not have the money at the time to pay. That is a probability difference, that he cannot pay the money to the lender who has taken money.
Okay.
As an example.
Okay, all right. Anybody else? Anyone else? What do you understand from probability of default? Okay, so you're fairly right about that. Probability of default simply means what is the probability that a company is going to default on its obligations. A company that has poor finances or a poor record of meeting obligations will have a high probability of default. Correct? What is loss given default? Loss given default is what is the loss that you as an investor will suffer if a default happens. So let's assume that I'll just take the example of, let's say, Yash. I heard Yash speaking. So let's just say, Yash, you hold a portfolio of AAA rated bonds Your portfolio has 65% AAA rated bonds. Your portfolio has AA rated bonds about 25% and A rated bonds another 10%. Okay. So yes, this is the portfolio of securities that you hold. AAA rated bonds 65%, AA rated bonds, your portfolio allocation is 25%, and you hold 10% bonds which are rated A. Now, let us say, so I hope you guys know very clearly that AAA rated bonds carry a very high credit worthiness. You expect AAA rated companies to return the money, right? So AAA rated bonds carry the lowest risk. Now, let us say what happens is your A rated bond or the companies to whom you've lent money which were A rated, they've now been downgraded to C rating. Okay. A company that has now been rated C, there is a very high probability that it will default. A company that is downgraded means that the probability of default with that company is now higher. So the company that has now been downgraded from A to C now carries a higher probability of default. What does that mean for you? The 10% that you've allocated to this particular bond that was A rated, there is a higher probability that this 10% of your portfolio will default. Now, what essentially happens is, let us say you had invested $100 in your portfolio, which means $65 went to AAA rated, $25 went to AA rated, and $10 went to A rated. This $10 is now at risk, correct? Because the $10 A rated bonds have now been downgraded to C rating. Now these $10 of yours are at a particular risk. If default happens, will you lose all of the $10? No, you will not lose all your $10. Why? Because even if the company defaults, you will be aware that when a company defaults, there are certain ways for the investor to recover money. Either the assets are sold, correct? Or you sue the company, there is a litigation process and you recover some money. So your loss is not always 10. You may lose $4. You may lose 4, which means what will you recover? You will recover $6 from the company. So in this case, your loss given default is 4 or 40%. Why is it 40%? Because your loss in case of a default was 4 out of the 10. You lost 4 out of 10, you recovered 6. So your loss given a default is 40%. That is what is your loss given default. So just because there is a default does not mean you lose all your money. LGD simply means what will be your loss in case there is a default. Now, the other question is exposure at default. What is an exposure at default? Exposure at default simply means how much money did you have exposed to that particular company which is now at the verge of defaulting. What do I mean by that? Let's go back to our example of the A-rated bond which was downgraded. You had allocated 10% to it. In other words, you had allocated $10 to it, right? Now, what if you have hedged $7 out of this 10? $7 is hedged, which means you've taken care of $7 out of 10. Even if there is a loss, $7 out of 10 you have already protected. What is your exposure then? Your exposure is $3. Why? Because you've already taken care of 7 out of 10. How? You bought insurance, through third-party guarantees, etc. 7 out of 10 you already protected, so that if there is a loss, 7 you will not lose. Your exposure is then $3, or exposure is 30%. Why is it 30%? Because it's $3 of 10. Correct? So in the example that we've taken, your exposure was 30%, your loss given default was 40%, and your probability of default you will get from the tables of probability, or you will get from published sources out there in the market. Correct? All of this gives you expected loss. So probability of default, loss given default, exposure of default together give you expected loss. All of this together will give you an idea about what is the loss that you can expect on your portfolio. Losses that differ from expected loss are unexpected loss. Okay, any questions here? Okay. All right, guys, let's do one thing. I usually like to take frequent breaks because, you know, online lectures, we need to refresh ourselves. So let's do one thing. Let's come back in 15 minutes and resume, or let's do 20 minutes. We'll come back at 10:30 and we're going to pick this up from here. Okay. Okay, guys, 10:30. See you.
Okay, sir.
Hi everyone, I hope we're all back.
Yes, sir.
Okay, guys, so let's pick up from where we left. We had completed discussing expected versus unexpected losses, known unknowns, unknown unknowns. There are a few terms that we're going to come across very, very often in our curriculum, which is first of those is called the VAR. It stands for value at risk. Okay, so just to give you an example of what a value at risk is, just give me one moment. I'm going to try to open my whiteboard. Okay, so value at risk, guys, is the most important risk measure that you will come across in risk management. Okay, this is a risk measure. Value at risk allows you to measure or quantify the risk. As an example, if I was to say that the 1 day value at risk at 95% confidence level is equal to $10,000. Now, in this statement, there are three important components. The first is the time horizon at which the value at risk is quantifying the risk, the confidence level, and the VAR itself. Okay. Let us say the portfolio that we are looking at is $100,000. Okay. The portfolio is $100,000. On this portfolio, the 1 day value at risk at the 95% confidence level is $10,000. What does this mean? This means, as there's some construction going on, so you may hear some disturbance. I apologize for that. This essentially means that on any given day, this portfolio can suffer a maximum loss of $10,000 with a 95% probability or a 95% confidence. In other words, I will rephrase this. I am 95% confidence that on any given day, this portfolio will suffer a maximum loss of $10,000. Are we all able to follow? What is the meaning of value at risk? Another example. 7 day VAR at 95% confidence level is equal to $50,000. This means I am 95% confident that over the next 7 days, the maximum loss in this portfolio will be $50,000. All right. That is what is the meaning of value at risk. Now, if you heard my definition was I am 95% confident that the maximum loss over the next 7 days will be $50,000. There is an exception or a corollary to this. What is it? There is a 5% chance that the loss in the next 7 days will exceed $50,000. Did you follow this, guys? I'm going to write this out here. Let's say this is a table that reflects losses. There is a 95% chance that in the next 7 days, the maximum loss will be 50,000. That is 95% chance the maximum loss will be 50,000. There is still a 5% chance that the loss will exceed 50,000. Correct? 95% is the confidence the loss will not exceed 50,000, but there is a 5% chance the loss will exceed 50,000. All right. And I'm just going to pause here. This is a very important concept. If you want me to repeat, I'm happy to repeat. Any questions?
Sir, value at risk basically means the maximum loss the company is facing in next particular period.
Do you want me to repeat value at risk definition? Is that what you mean?
Hey, value at risk basically means that what is the maximum loss which is going to be held in next days? Is that?
Yes, correct. Maximum loss with certain percentage of confidence.
We are confident that we are going to face this loss. this maximum loss.
Correct. Yes, exactly. So in the example I gave you, we are 95% confident that over the next 1 day, our maximum loss will be $10,000. This is value at risk definition in its complete form. 3 components. What is your confidence? What is the time horizon? And what is the maximum loss? But this can also be restated as there is a 5% chance the 1 day loss will exceed $10,000. Correct? That's very logical, right? You just have to apply logic. There is a 95% probability that the maximum loss will be $10,000. Means the loss will not exceed $10,000. There's 95% chance of that. But there is a 5% chance the loss will exceed $10,000. Okay. So if you've understood these 2 statements, you've understood the concept of value at risk. Now, let me move a little further. So again, I'm looking at this table reflecting losses. There is a 95% chance on any given day, the maximum loss will be $10,000, correct? 0 to 10,000. I'm repeating, there is a 95% chance the maximum loss on any given day will be $10,000. There is a 5% chance the loss will exceed $10,000. Now, here is where value at risk definition has a drawback. What is the drawback? It tells us that there is a 5% chance the loss will exceed 10,000, but it does not tell us how much will the loss be above 10,000. Will it be 50,000, 100,000, 10 million, 100 million, 1 billion? I mean, VAR does not tell us that. VAR just gives us a threshold of 10,000 and says that there is a 95% chance the maximum loss will be 10,000. There's a 5% chance the loss will exceed 10,000. If the loss exceeds 10,000, value at risk does not tell us how much will it exceed 10,000. It could be as much, right? That is a drawback of VAR. So to overcome that drawback, there is a concept called expected shortfall. This is another risk measure. It's called expected shortfall. What this does is it gives a precise quantified value of the potential loss. VAR does not give a value to the loss that can happen. Okay, it just gives us a threshold. There is a 95% chance the loss will not exceed 10,000. There is a 5% chance the loss will exceed 10,000. It does not give you the exact value of the expected loss. Expected shortfall gives us that value. So to that extent, expected shortfall is an improvement on value at risk. And we'll also come to how to calculate expected shortfall. But I hope you're now able to understand what is value at risk, how it is defined, what are the 3 components of value at risk, what is the drawback of value at risk, and how is it that expected shortfall improves on the concept of value at risk. Any questions? Okay. Guys, the next thing that I want to talk to you about is a concept that is often spoken about in risk management, which is called the RAROC, the risk adjusted return on capital. Okay. Now, very often you would have heard people say that, this stock is giving a higher return. This is a better stock. So let me just take the example. And with this example, we'll also move on to the next chapter. Okay. But I will cover the concept of risk reward. Stock A is giving a 10% return. Stock B is giving a 20% return. Which is a better stock? This is a question for you.
So we can't say that. So we can't. Hello.
Why can't we say so?
So we the risk appetite of both the stocks.
Yes. Thank you so much. That's absolutely right. Just because stock B is giving 20% return does not mean stock B is a better stock than stock A. Okay. Why? Because there is also a risk component that you have to see. What is the risk in stock A? Risk is seen as standard deviation, right? What is the standard deviation for stock A? What is the standard deviation for stock B? Let us say the standard deviation for stock A is 15%. The standard deviation for stock B is 75%. Now, in terms of risk reward, which stock do you think is better?
A.
A.
A is still better, guys. Why? Because A is giving you half the returns, but it is giving you 20% of the risk. It is giving you 50% returns of B, but it is giving you 20% of B's risk, which means risk versus reward, A is better. Let's look at another example. Similarly, let's ignore this now. Let us say A is giving you a return of 12%, B is giving you a return of 12%, A has a risk of 10%, B has a risk of 14%. Which is a better stock?
A.
A. In this case, also A. Why? Because the returns are the same. A has lower risk than B. So A is better. The concept is which portfolio stock gives you higher return for lower risk or the same return for lower risk, right? Or for a given risk, higher return. Another example, ignore this. Let us say both the stocks give the same return, 12%, 12%. No, let's say 12% and 13%. The risk in both the stocks is 10%. Please look at this. Return 12% for A, 13% for B. The risk is 10%, 10%. Which is the better stock?
B.
Okay, anybody else?
Sir, could you please repeat the question?
The return on A is 12%. The return on B is 13%. The risk in A is 10%. The risk in B is 10%. Which is a better stock from a risk reward perspective?
B.
B is better. Why? The risk is the same in both the stocks. For the same amount of risk, B is giving you slightly higher return. So B is a better stock here. So how you assess better portfolio or better stock is not just look at the returns, because the returns can accompany very, very high risk, and you may not want to take on that kind of risk. So always make an assessment of which portfolio is better, which stock is better by looking at a risk reward situation. Okay. Now, once that concept is cleared out, I want to also talk about the risk adjusted return on capital. So risk adjusted return on capital is essentially after tax risk adjusted expected return divided by economic capital. Now, we've not discussed economic capital as yet. You can ignore the term for now. We will discuss economic capital in detail in future. But just so you know, the risk adjusted return on capital simply means in the numerator, you're going to take after tax risk adjusted return. And in the denominator, you're going to compare it with economic capital. That is the amount of economic capital that you have deployed in order to get that return. That gives you RAROC, that is risk adjusted return on capital. If ever you are making an assessment of how well a portfolio has performed, you must always look at the returns on a risk adjusted basis, ideally after tax risk adjusted basis, and compare it with the capital that you've deployed or the risk per unit that you've undertaken to generate that return. That will give you a fair idea of the performance. Okay. Okay, so I have a little question here. If you've been able to follow the lecture, you should be able to answer this. Can you see this question here, guys? Which of the following is not included in the expected loss formula?
C, sir.
C, sir.
C.
C.
C? I heard a few B's. Did you say B or C?
C.
C. C. Okay. Correct. Expected loss does not have unexpected loss. Expected loss has probability of default, loss given default, and exposure at default. So guys, what I basically expect is in your first chapter of foundations, I don't expect any questions to come on the exam from this particular chapter, because this chapter is just about making you familiar with terms, okay, with all the terms that comprise risk management and foundations. So this is really about it. There is a little portion on enterprise risk management. I'm not going to discuss this here because there's an entire chapter on enterprise risk management. I'm going to bring it up then. Okay. So just give me a moment while I move on to the next chapter, which is, just give me one moment. How do firms manage financial risks? Okay, this is again an interesting one. So guys, how do firms manage financial risk? There are two ways to look at risk management. One is I should not say two ways to look at risk management. Risk management involves two important components. Okay, one is understanding your willingness to repay your debt, and the other is your capacity to repay your debt. So when you lend money to a company, or in other words, when you buy a bond of a particular company, buying a bond means you're lending money to the company. When you buy a bond, before that, what the assessment you make is the company willing to repay? Yeah, that's a question of willingness. And then the other is, does the company have capacity to repay? Which of the two do you think is more important, willingness or capacity as an investor?
Willingness.
Capacity.
Okay, I heard willingness, I heard capacity. Others?
Capacity.
Retaining the risk through insurance that can help in future.
No, that's not what I asked, Rishabh. My question is, if you are an investor and you want to invest in some bonds of a company, okay, you will make an assessment of what is the willingness of the company to repay the money, and you will also assess what is the capacity of the company to repay the money. For you as an investor, which one is more important, willingness of the company or the capacity?
Capacity.
Okay, it looks like everybody says capacity. Anybody for willingness? Okay, guys, so here's the thing. Strictly speaking, and let's apply some logic here, okay? This is pure common sense. Willingness is more important. And the reason for that is, if a firm is not willing to repay, I will repeat, if a firm is not willing to repay, having the capacity to repay does not help you. So let us say I bought bonds of Kingfisher Airlines before Kingfisher Airlines went bankrupt. Okay. I bought bonds of Kingfisher Airlines before Kingfisher Airlines went bankrupt. Vijay Mallya did not have the intention, which means he did not have the willingness to repay. He had the capacity. He still has the capacity. You know, Vijay Mallya owns stud farms. Vijay Mallya's net worth today is in excess of 30,000 crores. He has the capacity. Does he have the willingness? No, he does not have the willingness. Despite capacity, because willingness is not there, investors have suffered losses. So which one becomes more important? Willingness. Okay. Of course, I'm not saying ignore capacity. If a company does not have capacity to repay, you should obviously not lend money to that company. But what is more important is for you to make a qualitative assessment of whether the company has the willingness to repay or not. Because if the company does not have willingness to repay, then having the capacity or not having capacity does not matter. Now, the only problem with this entire logic is capacity to repay is quantitative and you can easily measure that. You know, you have a lot of ratios. You have solvency ratios, you have interest coverage ratios, etc., etc. You have so many ratios. You can easily quantify whether the firm has capacity to repay or not because it's quantifiable. It is very objective. But willingness to repay is very subjective. It's not easy for you to be able to quantify that. It is a judgment that you have to make. That is where assessing willingness to repay is difficult to do, but it is very important to do. All right. Then there's a concept called risk mapping, guys. Risk mapping simply means when you're looking at a company and you're trying to assess the risks, what you do is you understand what all different activities that firm is involved in. Now, once you made an assessment of the different activities that firm is involved in, you try and understand what are the different touch points or areas where there are risks, right? And you map those areas for the risks that they face. For example, if you look at a company like let's say an Infosys, Infosys faces multiple risks. The number one risk is business risk. Why? Because it's a very competitive market. Okay, you got Cognizant, you have Wipro, you have so many other companies which are competing for the same software, space that Infosys is competing with. So there's a business risk. And then there is a foreign exchange risk. Infosys receives revenues in foreign currency, which it has to convert into INR. So there's a foreign exchange risk as well. If Infosys has borrowed money from the market by giving out bonds, there is also the risk of credit default or downgrade risk, correct? So there are various risks that you can identify with the operations of a particular firm. It's called risk mapping. Understand the various activities that a firm is involved in and then try and map risks to each of those activities. The whole idea of risk mapping is that you're able to identify all risks correctly and you're not missing any potential risk. Just going to pause here. Any questions? Okay, so I have given you a brief definition of hedging a risk, right? I even gave you an example. If you hold an equity portfolio, you buy a portfolio of put options, the two are inversely related to each other. Equity falls in value, put options gain value, and you have a hedged position. So that essentially is hedging. When you're covering for your risks, you say that you're hedging. The obvious advantage of hedging is that you don't lose financial value, correct? Because you're hedged. That is the whole purpose of hedging. You don't lose money. Can anyone tell me what is a possible disadvantage of hedging?
Sorry, sir, what was the question?
We all know the advantages of hedging. They are very obvious. Can anyone tell me what is the potential disadvantage of hedging? Risk exposure.
So the money we put to hedge something, we can, in case the market does not goes the way it has to take the hedge position in a correct way, we can deploy the money in some other asset or some other place where we can get a better return.
Yes, that's a very good point. Correct. And this happens to be the single largest disadvantage of hedging. Hedging comes at a cost. Yes, I can see that Om has also put a comment, which is absolutely right. Hedging comes at a cost. Hedging is not cost free. Why? In the example I gave you, I said you have an equity portfolio, you buy put options and you're hedged. But the put options you buy come at a cost. You're going to pay a premium to buy put options, correct? Hedging comes at a cost. Hedging is profitable only if you are making sufficient return to be able to cover for the cost of hedging. Okay. So hedging comes at a cost. You have to decide, is that cost a good way of spending that money, or is it better that you remain unhedged? Hedging comes at a cost. So when you're spending certain amount of capital or resources in establishing the hedge, you've got to make an assessment. Is that the best way of spending your resources? You may decide not to hedge because you don't want to spend that extra money on hedging. You may want to go unhedged to save that capital, right? So that's the primary disadvantage of hedging. The other disadvantage of hedging that tends to be is hedging is a dynamic affair. You know, for example, in the equity put option example I gave you, you have an equity portfolio, you bought certain number of put options and you're hedged. Tomorrow, because the equity values would have changed, the number of put options you need to have a complete hedge will also change. You may need more put options. You may need less put options. It will incur transaction costs. Okay, so this is called a dynamic hedge. Dynamic hedge means you need to constantly keep tweaking your hedged position. It comes at a cost, you know, because you're going to incur transaction costs. So that's another disadvantage of hedging. So what it basically means is you've got to understand what is the meaning of right sizing risk management. Right sizing risk management simply means how much risk management do you want to do? In other words, if you decide to hedge, how much hedge do you want to do? Hedging comes at a cost. Do you want to completely hedge? Do you want to dynamically hedge every day? Or do you want to just partially hedge, save some capital? Right sizing the risk management, that is ensuring the risk management that you're conducting is of the right size. It should not be less than what you need, should not be more than what you need. Okay. Any questions, guys, so far? Okay, I have a quick question I want to show you here. Let me know what you think is the answer. Which of the following best describes risk capacity? Okay, I can see a few answers coming in. Everybody says B. Correct. That's absolutely right, guys. The total amount of risk that a firm can accommodate without becoming insolvent is risk capacity. Your response A, amount of risk the firm is willing to accommodate, is obviously willingness. Correct. That's absolutely right. Okay, we are moving along then. Any questions so far, guys? Please feel free to unmute yourself.
So, is hedging a good option to invest for better returns?
No. Hedging is not done for better returns. Hedging is always done to ensure you don't have losses. If you have the expectation of making a higher return, you do not hedge. The purpose of hedging is to ensure you don't have losses. The purpose of hedging is not to ensure you have profits. Okay. So if you want to invest to make profits, then what you're doing is you're speculating. Okay, hedging and speculating are opposite ends of the spectrum. They're completely opposite to each other. You speculate for a profit, to make higher gains. You hedge to ensure you don't have losses. Okay, the two things are very different.
Okay.
Okay, so let's move along. The governance of risk management, guys. When we talk about governance of risk management, what we're basically talking about is the governance related aspects that firms should have in order to manage risk better. Okay, for example, risk appetite awareness. The firm should be aware of what is its risk appetite, how much risk it can take on and how much risk it should not take on. That's called knowing the risk appetite. Board composition is another risk management governance feature. What is a board composition? The board of directors in a firm should be comprised of people who understand the business. It should not be family members and relatives of the management, right? Board of directors is there to have oversight on senior management to ensure that senior management is working in favor of the investors and customers, right? So the board is there to oversee the work of the senior management. So the board composition is very important. The board should comprise of people who have experience, who know the industry and who know the job of the company and who have sufficient control over the senior management. And then of course, governance also means that you should give priority to your stakeholders. It means that there should be oversight on how compensation are fixed. What do I mean by compensation? If the CEO of a company is told that your 80% of your compensation is dependent on the stock price appreciation, you think the CEO has the right incentives or the wrong incentives? From a governance standpoint. It's a question for you guys. Guys, I'm repeating. If the CEO of a firm is told that 80% or 90% of his compensation is dependent on the stock price appreciation, is that the right kind of incentive or the wrong kind of incentive from a risk management and governance point of view?
Wrong.
Wrong.
It's the wrong incentive.
Wrong.
Okay.
Wrong
Why do you
incentive.
think so?
You cannot know how the market will play in future. If right now it's working, going up and up, and tomorrow it's not sure that it will go down or up, depending upon that. This is
Okay. Anybody else? Why do you say wrong?
So due to economical factors, the market may fall, because of which the company may also fall.
Okay. I do want to clarify one point here. I'm sorry. I just wanted to clarify. When I say that 80% compensation depends on stock price appreciation, I mean the stock of the firm that the CEO is employed with. Okay. The stock of the same firm. So when the stock of the same firm goes higher, the CEO's compensation goes higher. You're saying this is a wrong incentive. So I'm asking you, why is that? Yash, go on.
So this is because the CEO the main function of the CEO is to see if the company is performing well, if it's properly making profits, and say presently the market is in a bullish form, so he will get a better compensation. Even if the company is facing losses, and suppose the company is doing very well, they are making very good profits, but the market is in a bearish state, he will not be properly compensated for that.
Okay. Okay. All right. I think I'm getting a perspective. So guys, your answer is correct. Okay. Wrong. Incentive. Okay. Your answer is correct. But I think the place where you come from to explain that is not entirely accurate. And I'll tell you why. So when I say that a CEO's compensation is dependent on the appreciation of the stock price of the firm that he's employed with, it is the wrong incentive, because it means you are telling the CEO, you take high risks. Take on risk. All that matters is the stock price should appreciate. Take all the risks you need to in order to ensure the stock price goes up, whether those risks are justified or are not. The other thing that happens is the CEO tends to have a very short-term horizon. All he's concerned with is in the short term, the stock price should appreciate, even though his actions may be causing long-term damage. He does not care for the long term. Why? Because his compensation is simply linked to the stock price. If the stock price appreciates in 1 year, his compensation goes up. Correct? So the incentives with such a compensation plan are flawed. You're giving an incentive to the CEO to take on much higher risk than what is good for the firm. He may take risk in his own selfish interest, which may not be good for the firm. Why? Because taking risk means the possibility of higher stock price. So that's good for him, but it may not be good for the firm. So all I'm saying is the job of risk management governance is also to have board of directors who ensure that compensation is set in a way that it does not give out wrong incentives. Now you understand what I mean when I say wrong incentives?
Yes, sir.
Okay. Yes, sir. Now, in this particular chapter, guys, which is called Governance of Risk Management, you will find that there is a detailed discussion of the primary responsibilities of the board of directors. I'm not going to cover all of this because it's very theoretical. I want you to just read this within 5-10 minutes in your own free time later on. If you have doubts, you come back to me. I'm just going to cover some of the very important aspects of this particular. I'm just going to summarize this for you. The first one is to steer the firm according to the interests of shareholders. Okay, that's the job of the board of directors. Second is that the board should ensure that staff gets rewarded according to their risk-adjusted performance. Not their performance only, but the risk-adjusted performance is what people should be compensated for. So if the CEO has brought a high performance, but he has incurred a very high amount of risk, his compensation should not go up by so much because he's incurred a lot of risk to generate that return. The board should check the quality and reliability of information. The board should be educated on risk management and should be able to determine appropriate risk appetite for the firm. Right? So just spend 5 minutes later on, read through this little more. This is very, very common sense. You should know what the board of directors is there to do. It is a very important component of governance of risk management. There is something called the RAS, the risk appetite statement. Now, the board of directors is responsible for drafting the risk appetite statement. What is the risk appetite statement? It is a document which summarizes the board of directors' view or perspective on what is the risk appetite of the firm. How much risk can the firm take on and what type of risk the firm can take on, what type of risk the firm should avoid, etc., etc. So it's the board of directors' assessment of the risk appetite of the firm. It is captured in what is called the RAS, the risk appetite statement. Okay. Now, as we move along, you'll also find in the governance of risk management, you'll also find the role of the audit committee. So within the board of directors, guys, there are multiple committees. Okay. So let us say a board of directors comprises of 10 people. Out of those 10 people, 3 could be part of the compensation committee, the one that I've just described to you. The compensation committee ensures that compensation is appropriately designed. Then you could have 2-3 members who are part of the audit committee, So you'll have an audit committee within the board of directors. That audit committee is ensuring the accuracy of financial and regulatory reporting that is done by the firm. It ensures that the firm complies with standards of regulatory, risk management, legal and compliance activities. And the audit committee verifies the activities of the firm to see if the reports outline the same. That means if the report that a firm is making about its activities is in line with the actual activities of the firm. So what we are basically saying is the audit committee of the board is like an internal auditor of the firm. Okay. And then there is a recommendation that every firm should have a risk advisory director. Okay, the RAD, the risk advisory director. What does the risk advisory director do? He oversees the risk management function, ensures that risk management policies, risks, etc. are all related to the overall business and information is disseminated appropriately. He ensures that there is mitigation, that is a reduction of risks like credit risk and market risk. The risk advisory director oversees financial reporting. He should look into requirements from a regulatory agency's perspective, and a risk advisory director also participates in audit committee meetings. Okay, so there is a recommendation that a firm should have a risk advisory director who is assisting with the risk management function of the firm, who is part of the board of directors. All right. So again, I don't expect questions to come from this on the exam, but this is important for your theoretical understanding because risk management is not just about formulae and derivatives. Risk management is also very subjective. Okay. It is about a risk management culture in the firm. I'm just going to pause here and ask if there are any questions so far. Okay. So we've just talked about the role of the risk advisory director. Guys, risk advisory director is not the chief executive of the firm. He's a board member who is overseeing the risk management in the firm. You also have a position called the chief risk officer. You guys all pursuing risk management, you may want to aspire to be CROs in firms in the future. What is a chief risk officer? Chief risk officer is a chief executive of the firm. He designs the risk management program. He designs the risk policies. He implements the risk management infrastructure. He monitors the firm's risk limits. And in many financial institutions like banks, the CRO is the intermediary between the board and the management. So the board and the management, the CRO sits right in the center of that. Okay. He's connecting the management to the board. So that's the role of the CRO. He's ensuring that he's basically the lead guy in managing risk in the firm. And he's part of the management of the firm. He's not part of the board. He's part of the management and he links the management to the board of directors, right? So that's the role of the CRO. You already discussed the role of incentives. I just want to allude a little more. I'll spend a minute on incentives because that's also spoken about in this chapter. If firms are given wrong incentives, the firms will indulge in activities which may not be fruitful for it or for the industry, and it can cause harm in the longer term. For example, some of you may have heard that the 2007-9 crisis was caused because of mortgage-backed securities. MBSs are financially engineered instruments which allow banks to do away with risk of loans, and that risk is transferred to investors. I'm going to discuss MBSs in detail later on. Okay, it's going to be a big part of your foundations. The last chapter is mostly about MBS. So I'm just very briefly covering this here. MBSs are complex financially engineered securities which allow banks to do away with risk on their balance sheet and transfer the risk to investors. Now, the incentive for the banks was that they can give loan to anybody. It doesn't matter. Why? Because the banks will not retain the risk of default on their books. The risk will be transferred away. So when the bank knows that the bank is not going to hold the risk of default on its books, it's going to give the risk away to somebody else. Will the bank be concerned with doing due diligence? Will the bank say no to anybody who walks in and asks for a loan? The bank will say, okay, fine. You want a loan? I'll give you a loan. Because if you default, I don't suffer the loss. I have mortgage-backed securities. I can transfer the loan out to an investor. So through these financially engineered securities, banks were able to transfer the risk away. As a result, the bank did not have an incentive to do due diligence. Banks continue to give loans to anybody, whether the person had a bad credit record or a good credit history, whether the individual could afford a loan or not, if whether the individual had an income to afford the loan or not, banks did not care. They just kept giving loans out. Why? Because the banks did not bother, because banks were not going to suffer a loss. Now, the obvious question on everybody's minds is how does that work? The bank gives a loan, but the bank does not suffer a loss. That is the beauty of mortgage-backed securities. That's the beauty of the process called securitization. We'll discuss that in much later on. But I just wanted to give you a little perspective on the role of incentives. If you give people the wrong incentives, they will misuse those. Okay. Okay, I'm going to pause here and ask if you have any questions, guys.
No, sir.
All right. Okay, so we've already discussed, I'm moving to credit risk transfer mechanism. I've already spoken about the different ways that we manage risk: accepting risk, avoiding risk, reducing risk, and transferring risk. Does anybody have a doubt with any of these? You know what each of these means, right? If you have a doubt, please let me know. Okay, looks like we are fine there. I want to talk to you about credit derivatives, right? And this is a very, very interesting part. You should understand credit derivatives really well, because we're going to discuss this in a lot of detail. So credit derivative is a type of instrument which derives its value from the credit worthiness. I'll give you an example. An example of a credit derivative is a CDS, which stands for credit default swap. So I'll tell you how this works. Let us say, and I'll take the example of who do we have here? I can see Rishik on my screen. I'm just going to put Rishik. Rishik, you are the investor. Okay. You hold a portfolio of equity securities worth $1 million. I'm repeating. Rishik is an investor. He holds a portfolio of securities which are valued at $1 million. Now, I'm sorry, this is not equity. He holds a debt portfolio of $1 million. When I say debt, essentially means $1 million worth of bonds he is holding. Now, what is the obvious fear in Rishik's mind? His fear is that the companies that have issued the bonds will default. Companies will not pay interest. The companies will not return the principal. This is Rishik's foremost fear in his mind. So what does Rishik do? Rishik goes to an insurance company, like let us say AIG. Rishik goes to AIG and says, I want to buy some sort of an insurance from you, AIG, such that if I suffer a loss on my $1 million portfolio, you make good my losses. AIG says, fine, that's okay with me. So you do one thing, you pay me a premium. AIG says to Rishik, you pay me a premium of $10,000. I will give you protection worth $1 million. This is a very hypothetical question, guys. In reality, the numbers will vary. AIG says, Rishik, you pay me a premium of $10,000 annually. I will give you a protection of $1 million. So what happens? Tomorrow, if Rishik faces a loss in his portfolio, let us say the bonds default, Rishik faces a loss. So Rishik goes to AIG and says, I faced a loss. AIG says, fine, as per agreement, I'm going to give you $1 million, right? This particular arrangement where Rishik pays a premium and receives protection in return. In other words, Rishik buys protection, is called a credit default swap. It is a form of credit derivative. Now, a few things here. It's a credit default swap. Credit default, why? Because it comes into question when there is a default, right? When these bonds default. That's why it's a credit default. Why is it a swap? It is a swap because money is changing hands. You're swapping premium payments for protection. Rishik is giving a premium and he is receiving protection. So it's a swap of a kind, right? It's a credit default swap. Now, why is it a credit derivative? Remember what I told you, a derivative derives its value from something else. This particular CDS, in this case here, is deriving its value from something. What is that something? That something is the credit rating of these bonds. The CDS derives its value from the credit rating of the underlying bonds. Now, here is my question to you guys, and I don't expect you to know the answer. Okay, if you don't know the answer, I'm going to tell you, but I just want you to think about this. Let us say before Rishik bought the protection, the bonds were rated AAA. Okay, the CDS is a security which can be traded in the market. Okay, let us say after buying insurance or after buying the CDS, the bonds have been downgraded from AAA to single A. So they've been downgraded from AAA to single A. What will happen to the value of CDS after the downgrade? Will the CDS as a traded security go up in value, or will it go down in value after the downgrade? This is my question to you. Think about it.
It will increase.
It will go up.
Okay. I can't see your comments, so you'll have to unmute yourself and give me your answer. Okay. I've heard two people say it will go up. I'm waiting for others. After the downgrade of the bonds, will the value of CDS go up or go down?
It will increase.
Okay, interesting. Anybody else? Anybody thinks the CDS value will fall? Okay, so here's my question, guys. Anybody? Anybody who's... Yeah, go on.
CDS will go up as I am paying the premium to CDS for the loss that the bond is taken care of, because from AAA it's getting rated to A, correct? So I as a person, as an investor, has paid CDS a premium amount to protect the risk of the side. As such a suggestion. I mean, are you wrong?
Okay, so your answer is correct, but your explanation is not. CDS will increase in value with a downgrade of the underlying bonds. Can anyone explain why is that?
So because there will be more chances of risk, therefore the CDS will increase.
Okay, you're saying because there is a higher chance of a default, so the CDS goes up in value.
Yes.
Yes, that's absolutely right. That is absolutely right. Let me explain this, guys. Let us say you hold the CDS, Rishik, and you take the CDS into the market after the downgrade. Okay, what is this CDS? This CDS for the market is simply an instrument where the holder of the CDS pays $10,000 premium and receives $1 million of protection. That is the instrument, right? Now, when the bonds have been downgraded to an A, what happens? The probability of default has increased, which means the probability of the payout of this $1 million has increased. Remember, the CDS is giving protection against default. So if the probability of default has increased, the probability that the holder of the CDS will get this $1 million payout has also increased. If the probability of the payout from a security has increased, the value of that security will also increase. Correct? Now, so it's possible, again hypothetical, it's possible that before the downgrade, Rishik found that CDS, he could sell the CDS in the market for $100. After the downgrade, he's able to sell the CDS for $300. If this bond gets downgraded further and goes into C category, probably this CDS will sell in the market for $10,000. Because the buyer of the CDS now feels that a default is so close, all I have to do is I have to hold the CDS. And if I'm holding the CDS while the default happens, I will be able to get the payout, right? So it sort of becomes a bit of a lottery and a jackpot sort of a game. Whosoever holds the CDS will get the money. That is why in 2007-9 crisis, every individual, high net worth individual, wealthy client, institutional or corporate investor was buying CDSs. Everybody was buying CDSs. Why? Because firms were defaulting left, right, and center. And everybody thought holding a CDS is a way to earn a jackpot. If you hold a CDS on a firm that defaults, you will get a payout. Correct? Okay, so that's a credit derivative called credit default swap. Any questions?
No, sir.
Okay, great. There are a few complications with CDSs. We're going to discuss those later when we talk about credit derivatives. Yes, Aryan, go on.
If there is no loss, then there's a loss of premium also.
Come again, please.
If there's a no loss, then there's a loss of premium.
Yeah, so just like what happens with insurance, you know, you pay 10,000 rupees to insure your car every year. If your car does not meet with any accident or there is no damage, what happens with the 10,000? It is sunk cost. You've lost that money. It's an insurance. Remember, what is it? It is to cover risk. It is to cover damages. It is not to make a profit. So a CDS is a derivative instrument used for risk management. It is there to ensure you don't suffer losses. It is not there for you to make a profit. Just like when you buy car insurance, you don't do it to make money out of it. You do it to ensure that you don't suffer a loss if your car gets damaged. Correct?
Yes, sir.
Okay. The next concept I want to talk to you about is called, by the way, guys, I'm parking CDO, which is a collateralized debt obligation, and collateralized loan obligations for later, because we're going to discuss this in detail when we talk about the last chapter of foundations, when we talk about the 2007-9 crisis. I want to talk to you about what is called a total return swap. It is another example of a credit of a derivative instrument. It's called a total return swap. Now, let's see how a TRS works. Total return swap. And I tell you, total return swap is very, very interesting. If you are students of finance and you love following markets, you should be very excited about what a total return swap does. If you want the returns of Nifty 50, you know what Nifty 50 is? Nifty 50 in India is the index that tracks the largest 50 companies in the country. If you want returns of Nifty 50, but you do not want to invest in the index, how do you do it? You can do it through a swap. If you want to get returns of a particular security, but you do not want to buy that security, how do you do it? You invest in a total return swap. By investing in a total return swap, you can get returns of a particular instrument without actually buying that instrument. I'll tell you how that works. How this works is, let us say we have two people here. I take the example of Aryan with us, and I can see Yash. So I'll just put Yash's name here. Aryan and Yash enter a total return swap with each other. Remember, it's a swap. It takes two people to enter this transaction. It's a contract. Aryan says Aryan will pay 5%, or no, let's make that 8%. Aryan will pay a fixed 8% per annum. Okay, the notional principal, there is no actual principal that exchanges hands. There is a notional principal because this 8% will be a percentage of something, right? It is 8% of a notional principal. Let us say Aryan and Yash agree that the notional principal for this TRS is going to be $1 million. Aryan says he will pay 8% fixed per annum of the notional principal to Yash. How much does that turn out to be? What is 8% of $1 million?
$80,000.
Correct. $80,000. So Yash, you're going to pay, I'm sorry, Aryan, you're going to pay Yash $80,000 fixed per year. And let us say this swap is an agreement for 3 years. So Yash, Aryan, you're going to pay Yash $80,000 each year for the next 3 years as part of your contract. What about Yash? Yash agrees to pay you the return of Nifty 50 each year for the next 3 years. Okay. So now let's see what happens here. Year 1, year 2, year 3. We have payment made by Aryan and we have payment made by Yash. Okay, this is what Aryan is paying. This is what Yash is paying. First year, what is Aryan paying? $80,000. Second year, Aryan is paying $80,000. Third year, Aryan is paying $80,000 fixed. Correct? Let us say the first year, the return on the Nifty was 14%. Nifty return, first year was 14%. Second year was 6%. Third year was, let's say, 9%. How much is Yash paying Aryan first year, guys?
140.
140,000. Yash pays Aryan. Second year? 60,000. Third year? 90,000. Correct? You see what is happening here? Aryan is getting the returns of Nifty 50. Has Aryan bought the Nifty 50 index? Has Aryan invested in any of the companies or stocks that comprise the Nifty 50? No. Correct? But he's getting the returns of Nifty 50. That is because he's invested in a total return swap where he is receiving the Nifty 50 returns. So in the first year, net, what is happening? Let's look at the net. When you net these returns in net, Yash pays $60,000. Correct? Aryan does not have to pay. Yash pays Aryan $60,000 and matter is settled. Do you understand what I mean? This is called netting of payments. Instead of two people making payments, you just net the payments. Aryan does not pay here. Yash pays Aryan $60,000 and year 1 settlement is complete. Second year, if you look at a net, who pays whom how much?
Yes, Yash pays 20,000. Oh, sorry, Aryan pays 20.
Correct. Aryan pays Yash how much? $20,000. Second year. That's it. Simple. One payment. $20,000. Aryan to Yash. Settled. Third year. Yash pays Aryan how much? $10,000. Settled. Okay. This is a total return swap. Effectively, what has happened is Aryan, in this scenario, look at Aryan, okay? Aryan has a liability which is fixed by nature and an asset which is floating by nature. Correct? He was paying 8% fixed, but here he's receiving the Nifty 50 returns. Effectively, without investing in Nifty 50, he is receiving the Nifty 50 returns. He knows what he's going to pay. He does not know what he's going to receive. You can look at it as a downside, but it depends on Aryan. If Aryan believes that Nifty 50 will definitely give at least 8% returns every year, then having a fixed liability of 8% versus receiving Nifty 50 returns each year, in Aryan's view, is a very good deal. You know, you could have somebody else. You could probably have, let's say, Tanish, right? I hope I've pronounced your name right. You could have Tanish, who believes that Nifty will have a very poor performance over the next 3 years. Nifty will give less than 5% returns. If Tanish believes Nifty will give less than 5% returns, will Tanish invest in this TRS that we've discussed?
No.
No. Correct. Why? Because if Tanish invests in this, he is effectively paying fixed 8%, but he expects Nifty, which is going to pay him, receive less than 5%. Why would he do this? He would never do this. So it's really about each one's expectation. Do you see how there's a qualitative subjective element here? Aryan expects Nifty to give more than 8% returns. That is why this TRS makes sense to him. But Tanish believes Nifty will not give such high returns. So this TRS does not make sense to Tanish. So what will Tanish do? If Tanish believes that Nifty will give 4% returns, what does he want to do? He wants to enter a TRS where his liability is fixed and he's paying 3%. Pay fixed 3%. and receive floating Nifty. Why? Because if Nifty gives even 4% or 5%, he's still making a profit. This is what Tanish will enter. Now, the point is, Tanish cannot just enter any contract that he decides to. He will have to find a counterparty who is agreeing to be part of the contract. So if Tanish is willing to pay 3% and receive Nifty 50, somebody else will have to agree to receive 3% and pay Nifty 50. Correct? There are always two people to a party or to a contract, no? If Tanish agrees to pay 3%, there is somebody who's agreeing to receive 3%. If Tanish wants to receive Nifty 50, the other person has to agree to pay Nifty 50. So this contract has to be agreeable to the other person also. What I'm essentially saying is you can form any TRS under the sun. You can agree to receive 100% per year on the notional principal and pay Nifty. I'm just swapping things around. You know, you pay 100% every year. You receive 100% every year and you pay Nifty. As long as the other party is agreeing to do it, you guys can enter a contract. And it becomes a total return swap. Why? Because you are swapping two different types of returns. I'm going to pause here and ask if there are any questions.
Sir,
Yes,
sir, it was like that one company is paying the debt at a fixed rate and one company is paying the debt as a floating rate.
You're absolutely right.
And
one of the other applications of a total return swap is an instrument called an interest rate swap. What an interest rate swap does is it allows a company to transform the nature of its liability. If a company currently faces a fixed interest rate liability, it can transform that into a floating rate liability and vice versa. That's called an interest rate swap. Now, just so that I'm able to test your knowledge here, let us say a company today faces a fixed interest rate liability of 6% on its debt. It has raised money and paying a fixed 6% on the debt. When would the company want to transform the nature of its liability from fixed to floating rate? Is it when it expects interest rates to go up in the future or go down?
interest rate will fall. LIBOR.
Okay. Anybody else?
When it decreases.
Decreases. Okay. Yes. I hope everyone's with me. The company would want to transform its liability from a fixed rate to a floating rate only when it expects interest rates to fall in the future. So that when interest rates fall in the future, because the company is sitting on a floating liability, its liability also reduces. Similarly, if a company expects, second example, guys, if a company is currently sitting on a floating rate liability, okay, I'll repeat, if a company is today sitting on a floating rate liability and it expects interest rates to go up, would it want to transform its liability from floating rate to fixed rate?
So can you repeat the question?
A company today sits on a floating rate liability. It expects interest rates to go up in the future. Would it like to transform the floating rate liability into a fixed rate liability?
Yes.
Yes, sir.
Yes, sir.
Yes, it will. Because if it sits on a fixed rate liability, when the interest rates go up, its liability rate does not go up. It is sitting on a fixed rate, right? This is another purpose of an interest rate swap. You're able to change the nature of your liabilities. We'll discuss interest rate swaps later, but again, this is another example of a derivative. Do you see, guys, how these swaps, which are derivative instruments, are being used for risk management? A company identifies it is sitting on a floating rate liability. It realizes that interest rates will go up in the future. It would like to transform its liability from floating rate to a fixed rate. It enters an interest rate swap and it does that. Essentially, they are managing their risk. Right at the start, I told you derivatives are a very common way of managing risk. This is another example of how derivative is used to manage interest rate risk. Okay. Okay, guys, let's do one thing. We're going to pause here, come back in about 15 minutes. Let's meet at 11:50, 11:50. All right. Okay, guys, we're pausing here, 11:50. See you. Hey guys, hi. I hope we're all back.
Yes, sir.
Okay. Okay, all right. Yes, Krisha, you have a question? Oh, sorry. Okay, you're giving a thumbs up. Okay, thank you. Thank you. I have a few questions on chat. Anshu, do you have any questions you want me to address now? By the way, guys, I've shared my contact number with you. Okay. I'm usually available on WhatsApp. So feel free to drop me a note or two. Don't expect prompt replies, but I'll reply when I can. Okay. Yeah, Yash, you have a question. Go ahead.
So where do we trade these swaps? Like for equity, we have a stock market. So where do we trade these swaps?
Good question, Yash. Thanks for that. So guys, when it comes to derivatives, there are largely four forms of derivatives. Okay. You have futures, you have forwards, you have options and swaps. Two of these are traded on the exchange and two of these are traded outside the exchange, which is called OTC. So the exchange traded derivatives are futures and options. Okay. So all your futures contracts, all your options, put options, call options, they're all available on the exchange. That is why futures contracts and option contracts are called exchange traded derivatives. Well, that leaves us with swaps and forward contracts. These are called OTC derivatives. OTC stands for over the counter. Do not visualize this as going to a shop and over the counter exchanging derivatives. These are called OTC, which essentially means a market outside the exchange. So to answer your question, Yash, how do you trade in a swap? What you have to do is you have to get in touch with a broker. A broker has networks in the industry. You go and tell the broker that you have a need to enter a total return swap. You want to be the pay fixed party. You want to be the receiving floating party in the Nifty. Look for a counterparty that is willing to take the counterparty side. The broker in his network will then get in touch, float the word around, and the broker will come back to you and say, yes, I have a counterparty in mind who's willing to be the counterparty to this TRS. And then you go ahead and you sign a contract with the counterparty. The broker will charge you a little commission. That becomes a contract which is legally enforceable. But again, because this is not done on the exchange, this contract is not visibly traded on the exchange. This contract is a custom contract that is created and traded outside the exchange. Okay.
Okay, sir.
Which is why if you are not able to find any contract that suits you on the exchange, you go to the OTC market and you create a custom contract and you look for a counterparty which is willing to take the other position. I'll give you one example. And I think this is a good time for me to even move to explaining the difference between futures and forwards. So here's how it goes, guys. I'll give you an example of a future contract. So Yash, I'll take your example here again. Let us say, Yash, that you own agricultural farmland and you know that in 6 months from now, you will have a harvest which you will be ready to sell in 6 months from now. Okay. You will be ready to sell your harvest. What you do not know today is at what price will you be able to sell it in the market 6 months from now. Correct? Because you are sitting here today. You don't know what will be the price later. So what you do is you enter a short futures contract. Short means to sell. So what position you take, whether you take a short position or long position, is decided by what is it that you intend to do. You intend to sell your harvest, so you will take a short position. If you wanted to buy something, you would have taken a long position. So you enter a short futures position to sell your underlying commodity. Now, as part of the futures contract, you will be obliged to sell a certain quantity of your commodity at a fixed price that is decided today at a certain date, which is decided today. So what is the quantity you will sell? What is the price at which you will sell? And what is the date when you will sell is all decided today as part of the futures contract. All you have to do is ensure that you live up to your commitment. Now, has it gotten rid of the uncertainty? Yes, it has. Correct? You today know at what price you'll be able to sell. So this is how futures contract works. Now, guys, just give me one moment. Now, this contract obviously worked for you because you knew that you will have a harvest ready to sell in 6 months, and there is a contract available on the exchange for 6 months. So you're able to buy that futures contract. What if on the exchange you have a contract which is available for 4 months, 8 months, 12 months? What you need is 6 months. What you have on the exchange are 4 month, 8 months, and 12-month contracts. Are you able to find the contract you need on the futures market? Yes or no?
No, sir.
Correct. You want a contract which allows you to sell your harvest in 6 months, but on the futures exchange, you're able to get contracts which allow you to sell your harvest in 4 months, 8 months, 12 months. So you do not get the contract that you want in the futures market. So what do? You go to the forward market. Forward market is an OTC market. Futures is an exchange traded instrument. Forward is an OTC instrument. So what do? Forward market, you express the desire that you wish to enter a forward contract with these credentials. Anybody who's willing to be the counterparty to this, please contact me. You will get in touch with the broker. The broker will get you a counterparty, and you will enter this forward contract with the counterparty. The only difference between a forward and a future then is a future is conducted on the exchange. This is conducted off the exchange in what we call OTC, over the counter. So your swaps and your forwards are OTC instruments, whereas options and futures are exchange instruments. Okay, guys, are we clear so far?
Yes, sir.
Great. Thanks for asking that. Guys, another important difference between a future and a forward is what is called a marking to market. Does anybody know what is the meaning of M2M, mark to market? Okay, I'll tell you what this means, guys. A mark to market is a feature of the futures contract. If you enter a futures contract, you as an individual trader, if you enter the futures contract, you have what is called a margin account where you are asked to bring funds before you enter the trade. So let us say you've been asked to bring 100,000 rupees into the margin account. You were told by the broker, until you put 100,000 rupees in the margin account, your trades will not be executed. You put 100,000 in the margin account and you buy the futures contract. Now, let's say at the end of, this is day 0. Let's say at the end of day 1, what happens is your futures value goes up by 10%. You had a long position, which means you had bought the futures contract. It has gone up by 10%. What is the value of the margin account now? $110,000, right? Because you gained 10% at day 1. Day 2, let us say the futures value has fallen by 5%. Day 2, the futures value has fallen by 5%. What is the value of the futures account now? Can anyone tell me?
100,000, 145,000.
145,000?
Yes.
No, it's fallen by 5%. 105.
105.
Yep. Your margin account is now down to 105,000. Now let us say on day 3, your futures contract suffers a further loss of 10%. What is your margin account now valued at?
Excuse me, sir.
Yes.
So when there was a 5% fall in the price, wouldn't it be 104500, because it was a fall from 5% fall from $110,000, right?
Okay. I'm not looking at the calculations. I'm just going by what you were telling me. So let me do it again. Day 1, the futures contract was up 10%. Your margin account went up to 110,000. Okay. Day 2, your futures contract was down 5,000. Was down 5%. So how much does that turn out to be?
104,500.
104,500. Your margin account was down to 104,500. Now on day 3, okay, your day 3, your futures account has fallen further by 10%. How much is that then? It is now down to 94,050. Correct? From day 2 to day 3, this is a fall of 10%. Your margin account at the end of the day 3 is 94,050. What I'm basically saying, guys, is there is a mark to market that is happening on a daily basis. Why is this done? This is done because, guys, your losses from your investments have to come from your pocket. Your broker is not going to pay for your losses. So what the broker tells you to do is he says, bring your own capital. On a daily basis, we will assess if your futures has made a loss or a profit, and we will let that reflect in the value of your investment. So on day 0, you invested 100,000. Day 2, your investment was worth 104,500. And then day 3, it fell down to 94,050. On day 3, your margin account was below the initial margin that you had brought. Now, this is how it works in a futures contract because it is exchange traded. Every exchange traded instrument will be marked to market on a daily basis. This is essentially done so that losses do not accumulate. Compare this with a forward contract. In a forward contract, you're not really required to bring any margin at the start. Okay. So if there are losses that are happening on day 2, day 3, day 4, day 5, they keep accumulating. And at the end, you're expected to repay those losses as an accumulated sum. Now, it is possible that when losses accumulate over a period of time, at the end of the maturity, losses have become so big that you're not able to repay them. Am I right or not? Are you following me? Because it is possible that over a period of time, losses accumulate to become so large that you're not able to repay them on maturity. That is why there is a mark to market where every day's loss is recognized on a daily basis so that losses do not continue to escalate. Now, what will happen is there is something called a minimum margin. Let us say the minimum margin is 90,000. If your margin account on any day falls below 90,000, your broker will say, okay, you know what, halt. I need you to bring fresh margin to bring your margin account back up to 100,000. This difference is called variation margin. So if your margin account goes below the minimum margin requirement, the broker will say, bring variation margin to bring your margin account back up to the initial margin. Only when you bring your margin back to the initial margin will we continue trading. If you do not bring this variation margin, what will he do? He will square off. Square off means he will book your losses. Right now, the losses are unrealized. They're only on paper. But if you do not bring additional margin, he will square off and book your losses. Because remember, if you do not bring additional capital to cover for your losses, your broker will not do it because these are your investments. It has to be your capital. Your capital is facing a loss. He's asking you to bring more capital. If you do not bring more capital, he will book your losses. Your losses will not be unrealized anymore. Your losses will become realized losses. This is where link this with liquidity funding risk that I spoke to you about earlier. Imagine you being Lehman Brothers. You are at the peak of the 2007-9 crisis. Lehman Brothers' portfolio has fallen in value because the markets have crashed. Lehman Brothers' portfolio has gone below the maintenance, has gone below the minimum margin. Brokers have asked Lehman Brothers to bring fresh capital to bring the margin account up to the initial margin. Lehman Brothers does not have money. Lehman Brothers goes to its partners and banks and fellow industry firms. They all refuse to lend money to Lehman Brothers. Why? Because they don't trust that Lehman Brothers will return that money because there is a loss of confidence. So what happens? Lehman is not able to bring the variation margin needed. So what do brokers do? Brokers square off Lehman Brothers positions and they book Lehman Brothers losses. So the losses that could have been unrealized and could have been recovered by bringing variation margin become realized losses because Lehman Brothers had a liquidity crisis. It was not able to bring fresh funds. Okay, I'm going to pause here and ask if you've been able to follow that. Even if you understood 25% of this, it's fine at this stage. We're going to be discussing this in detail. Any questions?
All clear, sir.
Okay, that's great. There's also a securitization question here, but I'm going to leave that for the last chapter in foundation. So we'll skip through that. Okay, there's a question here I want you guys to look at. Tell me if you're able to attempt this. What are the contractual specifications for the protection seller of a credit default swap?
So what is option D?
Aryan, are you saying option D?
No, what is the full option? I'm only seeing the first line only.
I'm sorry. Okay. Can you see the entire option? I just didn't want to show the answer. Answer is right below that. Are you able to see the complete option D?
A.
A is not.
Okay, guys, your answer is A. The protection buyer pays a premium, that's correct, to the protection seller at regular time intervals until a credit event occurs. What is a credit event? Bankruptcy, default, downgrade. In which case, the protection seller pays the protection buyer compensation for the credit event. Isn't that how insurance works? You pay the car insurance company a certain premium until the event occurs. What is the event? Damage to your car. So your answer here is A. Saurabh, I know that you said you do not know, but I hope you understood that now. Any questions, guys, so far? Okay, guys, we're going to move to a very, very important chapter. Okay, and I call this important because I expect questions from the exam from this particular chapter. This is called the modern portfolio theory, which is attributed to Harry Markowitz, which, if you've been following the news, very recently passed away. Harry Markowitz is considered the father of the modern portfolio theory, also called MPT. He very recently passed away. Now, what is the modern portfolio theory about? You heard me talking about risk return approach. Modern portfolio theory is all about risk return approach. Okay, it just dwells a little deeper into that risk return approach. There are some assumptions of the modern portfolio theory. First of all, one assumption is that there are no transaction costs. I want you to know that the assumptions that the portfolio theory makes are a little unrealistic and a little impractical. That is why you will find in economics, every theory has its limitations because every theory comes with assumptions. The modern portfolio theory comes with assumption number one, that there are no transaction costs or taxes. Number two, that all participants can access all available information at no cost. Okay, that's the second assumption of MPT. And the third assumption is that there is perfect competition in the markets. If any of these three conditions do not hold, the modern portfolio theory may not always be successful. All right. So just keep these three assumptions in mind. You can have a question on the exam. The question can be very simple. It can be a conversation between two candidates. It can be a conversation between a risk manager and the research analyst. Research analyst says that I'm trying to apply the modern portfolio theory. I can see that there are some transaction costs. Do you think the modern portfolio theory can still be applied? The risk manager says, yeah, transaction costs are not and are not considered in the portfolio theory, or transaction costs are not an attribute which are considered in the portfolio theory, the research analyst says, okay, thank you very much. I will go ahead and continue with my analysis. Now, is the statement made by the risk manager correct? No, it is not correct. It is incorrect. Transaction cost is considered in the portfolio theory. The assumption is that there are no transaction costs. You get what I'm saying? So, what I'm saying is just keep the assumptions in mind. You can be tested on your memorization of the assumptions of this particular theory, because this is a very, very important theory. So let me share my screen and give you a little artistic depiction of this theory. So here's what it is. And by the way, guys, my drawing is really bad. Okay, this is not my forte, so please excuse me for that. Give me a moment. Okay, so we have return, we have risk, or should we do it the other way? No, that's not. We have risk, we have return here. Now, let me draw a curve and show you something. I'm going to plot some portfolios, guys. Okay, I want you to tell me if which of the portfolios is more efficient. Okay, portfolio A versus portfolio B. Which of these is more efficient?
Portfolio
B,
B.
sir. B.
Why is it?
So because in portfolio B, we have the same risk as portfolio A, but the return is greater.
Absolutely right. Portfolio A and B have the same risk. I'll mark this as 1. Portfolio B has a higher return than portfolio A. Correct? Portfolio B's return is here. Okay, now tell me, which is a better portfolio? Portfolio B or portfolio C? Sorry?
The portfolio C.
Why is that?
So because risk is less, and because risk.
Others, what do you say? Which is better?
So portfolio C, because the amount of risk which is changing is more. The risk that is being decreased is more than the return that is being decreased.
Are you sure?
Sir, it is a minimum efficient frontier.
Okay, it is the minimum of the efficient frontier. I've not come to the efficient frontier yet, so I'm going to ask you to park that for now. Guys, between portfolio B and C, we cannot tell which is more efficient. Portfolio C reduces risk from 1 to 2, but it also gives you lower return from 1A to C. I don't think you can tell from the diagram if the risk reduced is more than the return reduced. C is giving you less risk, but it is also giving you less return. Compare this with B. B is giving you higher return, but it comes at a higher risk. Which is better, B or C, you cannot tell. Okay. Which is better, A or B, you can very clearly tell, because A and B at the same risk are, B is giving you higher return, right? Now, all portfolios which lie on this particular line segment, which do not have an obviously superior portfolio, comprise the efficient frontier. So I'll call this portfolio D, portfolio E, portfolio F. Again, my same question to you. Which is better between portfolio F and portfolio D? Can you tell? You cannot tell, because F is giving you higher return, but F is also coming at higher risk. What about D and E? You cannot tell which is better. E gives you higher return, but it comes at a higher risk. Correct? Portfolio E and F, you cannot tell which is better. F is giving you greater return, but it comes at a higher risk. All portfolios that fall on the line segment for which there are no obviously superior portfolios comprise the efficient frontier. So your efficient frontier starts from portfolio C, which is called the minimum variance portfolio, all the way, and I'm creating a dotted line here. Your efficient frontier is this entire dotted line. All portfolios that fall on this dotted line fall on the efficient frontier. You understand why this is the efficient frontier? Any portfolio that falls below the efficient frontier is an inefficient portfolio because there is a superior portfolio to that. For example, let's look at portfolio G here. Should the efficient frontier extend up till portfolio G? No. Why? Because there is a portfolio on the efficient frontier which is more efficient than G. We'll call it H. How is this more efficient than G? For the same risk, H is giving you more return. So G does not fall on the efficient frontier. So all portfolios below C do not fall on the efficient frontier. So your efficient frontier comprises C, H, B, D, E, F, and so on and so forth. This efficient frontier can be extended indefinitely upwards. That's your efficient frontier. I think I lost my screen share. Give me 1 second. Okay, so I'll just draw this again. I'm sorry, poor artistry again. Return, risk. Our efficient frontier is this. Remember, this part is not the efficient frontier. This solid upward sloping line is our efficient frontier. And the portfolio that falls on the extreme left is called the minimum variance portfolio. Why? Because this is the portfolio on the efficient frontier which carries the least variance. Variance is what? Standard deviation squared. This is standard deviation on the x-axis. Risk is standard deviation. The portfolio which carries the lowest standard deviation, which means the portfolio that carries the lowest variance, is the minimum variance portfolio that falls on the extreme left of the efficient frontier. Okay, Yash, you have a question. Please go ahead.
So what is an efficient frontier?
Efficient frontier is comprised of portfolios which do not have an obviously superior portfolio to them. For example, the portfolios that fall on the dotted line are not on the efficient frontier because there is a corresponding superior portfolio that falls on the efficient frontier. Efficient frontier are portfolios that from a risk reward perspective are superior.
Okay, sir.
Okay. All portfolios, any point on this line carries portfolios which are efficient. That's because they fall on the efficient frontier. You see how if I extend this line here, this is not the efficient frontier because any portfolio that is here offering you this return for this risk for this return will have a portfolio on the efficient frontier that offers you higher return for the same amount of risk. So this is an inefficient portfolio. So it does not fall on the efficient frontier. Efficient frontier is only this part. This particular line segment is your efficient frontier. This is your modern portfolio theory. When you are faced with a portfolio as an investor, all that you have to do is you have to try and identify. Again, I'll redraw this. This is risk, which is standard deviation, and this is return. When you are faced with a portfolio, all that you have to do is you have to identify where does that portfolio fall? Does it fall on the efficient frontier? Or does it fall below the efficient frontier? Does it fall right on it? Is a portfolio here? Or is the portfolio here? Or is the portfolio here? Would you prefer this portfolio, let's call this A, over this portfolio, let's call this B? Would you prefer A over B?
A.
Correct. A is better than B. How about B versus C?
B.
B is better than C. Correct. Portfolios that fall below the efficient frontier are inefficient. Portfolios that fall on the frontier or above the frontier are efficient. Okay, guys? So that's your efficient frontier. And this is your entire modern portfolio theory. Tell me if you can see this, guys. Optimal and suboptimal portfolios. You can see this, right? Portfolio P gives the best return for the same level of risk. On the other hand, portfolio K is termed as suboptimal. This is K here. this is portfolio K, is termed as suboptimal since there are other portfolios located on the vertical distance between the portfolio K and the efficient frontier that can offer better returns. You see that? This K is considered suboptimal, means it is below optimal, inefficient, because there are other portfolios like the one that lies on the efficient frontier, which is more efficient than this. Why? Because same return, same risk, greater return. Got that? So that's your modern portfolio theory, guys. Okay, I'm moving along to another very important topic, which is a derivation from the modern portfolio theory. It's called the CAPM. CAPM is the capital asset pricing model. The capital asset pricing model. What does the CAPM tell us? CAPM basically tells us how to find the expected return on an asset. And the formula it gives us for that is, it says expected return on an asset is the risk-free return plus the beta of the asset multiplied by return on the market minus the risk-free return. This is your capital asset pricing model. I can assure you, you will get questions on this on the exam. The CAPM is a derivation of the modern portfolio theory. Why? Because it takes risk and reward into account. Okay. So let's get started. Expected return on any asset is equal to the risk-free rate. What is the risk-free rate? Risk-free rate is like, let's say in India, the 10-year Government of India security, right? There is no risk on Government of India bond. So let's say the Indian Government of India bond 10-year is selling at offering 6.5%. Let's say 7%. Your risk-free rate in India becomes 7%. Plus the beta of the asset. What is the beta of the asset? Beta of an asset is how well that asset price moves in tandem with the broad market. Give you an example here. Let us say TCS and let's look at Nifty. If the Nifty goes up by 10% and TCS goes up by 10%, the beta of TCS is equal to 1. Why? Because when the broad market moves up by 10%, the TCS stock is also going up by 10%, the beta is 1, which means the TCS is very well tracking Nifty. If Nifty was to go up by 10% and TCS was to go up by 5%, beta of TCS in the second case is 0.5. Because TCS is only going up by half the amount the broad market is going up. Get it? So that is beta. This is beta of that asset that you're trying to arrive at the return for. Beta of the asset is this particular term, beta I, multiplied by return on the broad market. In our case, you can say Nifty, minus the risk-free rate. RF is risk-free rate. So this is your capital asset pricing model, which tells you what should be the expected return on an asset. So when you're trying to make a decision whether to invest in a particular security or not, you will try to calculate what is the expected return on that security. If you're using the CAPM model, this is the formula that you will apply. The risk-free rate plus beta of that asset multiplied by return on the market minus the risk-free rate. This will give you the expected return on that particular security. If you believe that that return justifies the risk you're taking by investing in that security, you will decide to invest. If the return on that security is lower than what you believe is justified because of the amount of risk that you will be taking on in investing in that security, you will decide to not invest or you will go short on that security. Okay, so that is how your CAPM model works. Now let's look at a few. I think we may have.
Sir,
Yes.
excellent, sir. Can you please summarize with CAPM one?
Sure. So let me share my screen here.
Sir, no doubt.
Yes, go on.
Sorry, beta is that the systematic risk.
Yes, I was coming to that. Beta is also called systematic risk. I'm going to talk about beta as systematic risk when we discuss unsystematic or idiosyncratic risk. So yes, your beta is the systematic risk.
It will come later.
Yes, we will be covering that.
Okay.
Okay, so here we are, guys. This is your CAPM. Expected return of the asset. RF is the rate of return on the risk-free asset or the risk-free return. Beta I is the beta factor of the asset. RM is the expected market return over the holding period. Market is the broad-based market. So like I said, the example I gave you was if Nifty goes up by 10% and TCS goes up by 5%, TCS beta is 0.5 because TCS is responding to the broad market by half. Correct? The broad market went up by 10%, TCS went up by 5%. So the beta is TCS. TCS is tracking the market by exactly half. Correct? On the other hand, if the market went up by 20% and TCS went up by 40%, what is the beta of TCS? 2. Beta of TCS is 2. It is tracking the market 2 times. Okay, so that is beta. Beta is essentially the sensitivity of that particular instrument to the broad market. Beta is also called systematic risk. Okay. Just letting you know at this stage, I'm not going to discuss systematic risk in detail, just to let you know, because you can find systematic risk and beta used synonymously. Okay. Beta is also called systematic risk. There is something called unsystematic risk. We'll discuss that later. So this is your CAPM model. Now, let me see if there is any question on the CAPM. Okay, I can show you a graphical representation of CAPM. Here we go. Let me know when you can see my screen. So this here, you see this particular curve, green, this curve in green, SML. It's denoted as SML. This curve SML, which means the securities market line, is the graphical representation of CAPM model. And I'll tell you what this means. SML is the same as CAPM. This particular green line here, which is called the securities market line, is the graphical representation of the CAPM model. Now, what is happening here is you have the risk-free rate here on the y-axis. Why is this risk-free rate a little above and not starting from 0? It's obviously because the risk-free rate is a certain interest rate. It is not 0. The risk-free rate in India is 6%. So let's just put 6% here. The risk-free rate is 6%. So the intercept of the SML is 6%. You remember your intercept from your 12th math, if you've done, your expected return on CAPM is RF plus beta into return on market minus RF. Correct? This is your intercept term. That's your intercept. And this is the slope. If you've done your regression equations from 12th, you will know that the first term in this equation is the intercept. This coefficient is the slope. What is the coefficient? Coefficient is the beta. That's your slope. Okay. So when you graphically represent the CAPM, it produces a line called the SML. And this line is the graphical representation of the capital asset pricing model. Now, let's see what it means for us. Please note here, guys, we've been given the formula for beta. You can calculate beta as this. Do you see this? This is correlation of the asset with the market multiplied by the standard deviation of the asset divided by standard deviation of the market. You should know that covariance can be depicted in the form of correlation, right? The two are similar to each other. Correlation can be shown as covariance and covariance can be shown as correlation. So your beta can be reflected as the correlation between the asset and the market multiplied by the standard deviation of the asset upon standard deviation of the market. This is your beta of an asset. Do you see how beta is taking into account its correlation with the market and how it is linking the risk of the asset with the risk of the market? That is what I told you, right? When Nifty goes up by 10% and TCS goes up by 5% and the beta is 0.5, beta is taking into account the linkage between TCS and the market, the risk of the market with the risk of TCS, the correlation of the market with the correlation of TCS. So that's the formula for beta. Now, what you can do is, you remember the formula for CAPM, which was RF plus beta into RM minus RF. You can put, instead of the beta here, you can put this, and what you get is this equation here. You get how we get this? This is correlation of asset and the market multiplied by standard deviation. This is correlation of the asset and the market. This is standard deviation of the asset. And this is the standard deviation of the market here. So your CAPM equation can be rewritten as this. Return on the risk-free asset plus correlation of the asset and the market multiplied by standard deviation of the asset multiplied by return on the market minus RF. This is part of the original CAPM formula. This stays like this, divided by the standard deviation of the market. Now, guys, it's important for you to memorize this particular formula for CAPM. Even if you do not want to remember this formula, you can ignore this one. But what is important is that you should understand CAPM as being risk-free return plus beta into RM minus RF. This is going to be the most important formula for your level 1 in your preparation. Okay, you're going to be tested very often on this. Okay, I'm going to pause here to ask if there is any questions so far.
No questions, sir.
All right, pretty good. Let me move on. So what is SML? SML is a graphical representation of the CAPM model. If you get a question which says, how do you graphically represent CAPM? You should know SML should strike you right at the start, okay? Okay, just give me one moment, guys. Would you prefer a beta? Would you prefer to invest in a stock which has a beta of greater than 1 or less than 1?
Greater than 1.
Greater than 1.
Okay.
Less than 1.
Less than 1. Okay. So my question then is, for those who said greater than 1, would you always prefer to invest in a stock that has a beta greater than 1?
No, sir.
When would you not prefer to invest in a stock that has a beta greater than 1?
When the market is bearish.
Yes. Thank you. Absolutely. Remember, guys, what I told you, beta greater than 1 means the stock is moving more than the market. Okay. And that does not apply to just up movement. It also applies on the down movement. So if a stock has a beta of greater than 1, let's say the beta is 2, the market falls by 10%. How much will your stock fall by?
20.
20%.
You don't want that, right? So again, please bear in mind, it sounds great when we say beta is greater than 1. I will beat the market. Okay, I want to buy stocks that have a beta greater than 1. I'm going to beat the market. It works both ways. It is a double-edged sword. If you're beating the market on the upside, you'll also beat the market on the downside. So if the beta is greater than 1, understand if you're expecting a bear market where the stocks will fall in value, you actually want a beta of less than 1. You do not want a beta of greater than 1. You prefer a beta of greater than 1 if the market is in a bull market where the stocks are going up in prices. Okay. So it depends on your expectations. don't assume that beta greater than 1 is always a great bet. Is that okay, guys?
Yes, sir.
Okay. Now I'm going to talk to you about the capital market line, and I'll tell you the difference between the CML and the SML. There's a very subtle difference between the two. Let me know if you can see my screen. You remember I showed you SML. This is the CML now. Can anyone tell me the difference between the two when you just look at the graph? SML was very similar. You remember the intercept was the risk-free rate above 0. It was a linearly upward sloping line, straight line. You have risk here, you have return here. What is the difference between CML and SML, the way you see it?
So what is the slope of CAPM?
Slope of the CAPM is beta. I'm sorry, go on. Can anyone tell me what is the difference between CML and SML? The difference is visible in the graph. Okay, this is the graph for CML, and I'll show you the graph of SML. I showed you a moment back. This is SML. Can you tell me the difference? They look very similar because they are very similar. This is SML. I'm going to scroll down to CML now.
Low SML.
This is CML. Okay, I'll tell you the difference, guys. The difference is the x-axis. The x-axis here denotes standard deviation. The x-axis in SML denoted beta. Okay, and that is where the difference is. Beta is systematic risk, whereas standard deviation is total risk. So I'll tell you the difference. Okay, give me one moment. Right. So total risk comprises of systematic risk plus unsystematic risk. Okay. Systematic risk is denoted with beta. Total risk is denoted as standard deviation. So wherever you see standard deviation, you are basically looking at systematic risk plus unsystematic risk. In other words, this is equal to beta plus unsystematic risk. We'll call unsystematic risk UR. Okay. Total risk is equal to systematic risk plus unsystematic risk. Now, what is systematic risk and what is unsystematic risk? So let me come to this. Beta, which is systematic risk, implies risk that you cannot diversify away. Risk that will find its way this way or that into your portfolio. It is the risk that the broader market brings to your portfolio. In other words, to simplify, systematic risk is the risk that cannot be diversified away. Let me give you an example. You have a portfolio A, you have a portfolio B. Portfolio A has 2 stocks, portfolio B has 25 stocks. Okay. If you look at total risk, which is systematic plus unsystematic risk, portfolio B has less unsystematic risk than portfolio A. Why? Because portfolio B is better diversified. When you increase diversification, you reduce the unsystematic risk. Portfolio A has very high unsystematic risk. Why is that? Unsystematic risk is essentially the risk that an individual stock brings with it. If your portfolio is comprised only of 2 stocks, the 2 stocks will bring a huge amount of risk with them. Are you following? Portfolio A has very high unsystematic risk because it has only 2 stocks, or let's make it 1 stock. Portfolio A has maximum and the highest possible unsystematic risk because the entire portfolio is comprised of only 1 stock. So that 1 stock is contributing heavily to the risk. Okay. Compare that with portfolio B, which has 25 stocks. An individual stock among these 25 will have limited contribution to the risk of the portfolio. So by diversifying the portfolio B, you have reduced the unsystematic risk. But by diversifying like in B or not diversifying like in A, you do not change the systematic risk. Systematic risk is there in both because that is the risk that the broad market brings with it. You cannot diversify this away. In other words, beta cannot be diversified away.
Sir, but how in portfolio A there is high risk?
I'll tell you.
Because it has only 1 stock.
Yes. Portfolio A has higher unsystematic risk. So let me just draw this again. Portfolio A has 1 stock. Portfolio B has 25 stocks. A has greater unsystematic. The unsystematic risk of A is greater than the unsystematic risk of B. Why? Because portfolio B is well diversified. A well diversified portfolio will have less unsystematic risk. Why? What is unsystematic risk? Unsystematic risk, in other words, is also called idiosyncratic risk. Idiosyncratic risk or unsystematic risk is the risk that an individual stock brings with it to the portfolio. Okay, so let us say this 1 stock in portfolio A is TCS. What happens with TCS will very heavily contribute to the returns of portfolio A. Am I right or not? Just let me know, guys. I'm going very slow. I want you to understand this concept. What happens with TCS, the firm will contribute heavily to portfolio A's return, which means the idiosyncratic or unsystematic risk of TCS is contributing heavily to the returns of portfolio A. So the unsystematic risk of portfolio A is very high. Whereas with portfolio B, there are 25 stocks. TCS may be one of them. Is TCS contributing to the return and risk of portfolio B the same way it is contributing to the return and risk of portfolio A?
No.
No. Correct? Which means portfolio B has less unsystematic risk. Why? Because no individual stock is contributing very heavily to the risk and return because it is very well diversified. That is the whole point of diversification. If you can diversify and reduce unsystematic risk, please reduce it. Okay. So B is lower on unsystematic risk than A. But here's the $1 million question, guys. And this is to answer the question, this gentleman just had. Portfolio A has 1 stock, B has 25 stocks. Markets, and please remember this for life, guys, okay? Markets reward risk taking. Correct? Is this what you heard? You take a risk, you get a return. You heard that? This statement is not complete. Markets reward risk taking, yes, but markets reward only systematic risk taking. That is beta. Only if you carry beta in your portfolio will you expect a return from the portfolio. When you increase the beta of your portfolio, you expect a higher return on the portfolio. Okay. Beta is systematic risk. You are rewarded for systematic risk. Why is that? Because unsystematic risk can simply be diversified away. Why should the market reward you for a risk that you can easily get rid of? I'm repeating myself, okay? And please hear this very carefully. Why will the market reward you to take on some risk that you can easily get rid of? The market will reward you for taking on a risk that you cannot get rid of. Are you following me? Unsystematic risk can be easily diversified away, so the market will not reward you for this. The market will reward you for taking on greater systematic risk or taking on a greater beta. If your portfolio has a high beta, the market will reward you for it. If your portfolio has a high unsystematic risk, you should not expect the market to reward you for it. That is why if you sit on a portfolio of one stock, do not expect to beat the market. Your one stock is contributing heavily to the portfolio's performance. You have a very high unsystematic risk. You are unnecessarily taking on a high unsystematic risk when you can easily get rid of that by simply diversifying. So when you diversify from portfolio A and move to a portfolio B, which is better diversified, your beta is the same, but your unsystematic risk has reduced. So you've reduced that component of the portfolio which you are not getting rewarded for. Why should you carry unsystematic risk when you're not going to be rewarded for it? So you get rid of it by diversifying. And that is the whole concept of modern portfolio theory, which says, understand that the market rewards risk, but it does not reward total risk. It rewards systematic risk. I'm going to pause here and ask if there are any questions.
Sir?
Yes.
I have a little bit of confusion that in portfolio A, only the one stock is means we are having a systematic risk.
Systematic risk is there in both, because the broad market is contributing to some amount of risk in both portfolios, right? TCS has interaction with the market. Portfolio B also has interaction with the market, right? So there is systematic risk in both portfolios, but the unsystematic risk in portfolio A is much higher because it is getting unduly affected by one stock.
Okay.
Is that okay? Anybody else? Any other questions? So the simple point here, guys, is if you are making a risk reward assessment by looking at total risk, you look at SML. If you're looking at the risk reward assessment by, if you're looking at risk reward assessment by only looking at beta as the risk, you look at the SML. If you're trying to see the risk reward by looking at total risk, you look at the CML. For all practical purposes as investors, SML is of more value because SML looks at beta, which is systematic risk. That is what rewards you. Higher systematic risk will give you the rewards. Taking on unsystematic risk is useless. You will not be rewarded for it because the market knows that you're taking on an unnecessary risk. Why? Because it can easily be diversified away. When a risk can be diversified, you will not be rewarded for it. So instead of holding a portfolio with one stock, two stocks, hold a portfolio with 25, 30 stocks. Your unsystematic risk will be reduced. You will only sit with systematic risk. So you increase the beta, you are increasing the expectation of return. You increase unsystematic risk, you should not expect higher return. Okay, so guys, that is the most important crux of this entire argument here. I have shared with you the concept of systematic and unsystematic risk. Systematic risk is beta. I've told you what is an SML. It is a graphical representation of the CAPM. CAPM is the theory which signifies the modern portfolio theory, which was attributed to Harry Markowitz, which is essentially a discussion of the efficient frontier, the risk versus reward, correct? So form a chain of thoughts like this and you're going to remember everything. I'm going to take you through a few risk measures now. Let me share my screen and show you this. Okay, here we are. So there's something called, yeah, go on.
So we can say that the systematic risk is a type of risk which cannot be where mitigation is not possible.
You're right. You cannot mitigate systematic risk because systematic risk, as the name suggests, systematically finds its way into the portfolio. It is the risk that the broad market lends into the portfolio. You can never create a portfolio which has nothing to do with the broad market unless you're completely hedged, right? If you hold a stock of equity securities, it will have an interaction or a correlation with the broad market. That risk is beta. You cannot do that away with. Whether you have one stock or 100 stocks, you will have beta in your portfolio. Beta is what you're rewarded for.
Thank you.
Okay. Now the Sharpe ratio, guys, again, a very important ratio. Sharpe ratio is essentially the risk to reward ratio. It just tells you higher the Sharpe ratio, the better reward to the risk you're taking. Expected return on portfolio minus the risk-free rate divided by the risk. okay, on the portfolio, or the standard deviation on the portfolio. So your numerator here is the risk adjusted return. You get it? Why is it the risk adjusted return? Return on the portfolio minus the risk free rate, the return in excess of the risk free rate. That's your risk adjusted rate divided, sorry, not the risk adjusted rate. This is your, in other words, this is the return that you make over and above the risk free rate divided by the standard deviation, which is the risk. So the numerator is the reward that you're getting. Denominator is the risk that you're taking. So the Sharpe ratio tells you the reward to risk ratio, right? Higher the Sharpe ratio, the better it is. And then you have trainer. You see the difference between Sharpe and trainer here. Can you see both Sharpe and the trainer ratios? I'm sharing my screen. Are you able to see both?
Yes, sir.
You see the difference between the two? The only difference between the two is the denominator. Sharpe ratio has total risk. Trainer is also a risk reward ratio, but this is only systematic risk. Correct? Do you see this, guys? Numerator is the same for both of these. So both Sharpe and trainer are reward to risk ratios.
But trainer ratio is not visible.
Exactly. The trainer ratio only looks at systematic risk, whereas the Sharpe ratio looks at the total risk. So now here's the
trainer ratio is not visible.
Sorry?
Formula is not visible, sir.
Trainer formula is not visible. Okay. I asked somebody, he said yes, it was. Just give me 1 second. Okay, do you see the formula now for trainer? This is the trainer.
Yes, sir.
Numerator is the same as the Sharpe ratio, okay? Sharpe ratio had a denominator of total risk. Standard deviation, which is total risk. That was the Sharpe ratio. The trainer ratio is this same numerator, but systematic risk in the denominator, beta. Okay, so now here's my question to you guys. If you initially held a portfolio A with 1 stock, and then you move to a portfolio B, which has 30 stocks, has your trainer ratio improved? Everything else is constant. Okay, let's assume everything else constant. Has your trainer ratio improved or has your Sharpe ratio improved?
Sharpe ratio has improved.
Okay, Sharpe ratio has improved. What else? Anybody else? Om says no effect on trainer. Ronald says Sharpe has improved. Saurabh says Sharpe has improved. Can anyone tell me why has Sharpe improved and why is there no effect on trainer?
So because systematic risk will be same in both the portfolios, so trainer ratio will be same.
Exactly, absolutely right. By making the only change that you've made is you've diversified your portfolio. You moved from A to B. Because you've now diversified your portfolio, the only change that you've made is that you have reduced unsystematic risk. You still have systematic risk. You've only reduced unsystematic risk. Unsystematic risk is not considered in trainer. So the trainer ratio remains unaffected. Assuming other things are constant. Obviously, when you're moving from a 1 stock portfolio to a 30 stock portfolio, your expected return will change, etc. I'm assuming everything else remains the same. Your trainer will remain unaffected. Your Sharpe ratio will be affected because Sharpe ratio is beta plus unsystematic risk. And now unsystematic risk has fallen. So your Sharpe ratio will be affected. Your trainer will remain unaffected. Okay. You've heard the term alpha very often, right? This asset manager is creating an alpha. I'm looking for an alpha. I want an alpha return on my portfolio, etc., etc. What is alpha? Alpha is simply Jensen's alpha. Do you see the screen here? Where is the, yes. Here is your Jensen.
Alpha is the stocks which get less returns, right?
No.
It is less risky, I guess.
No, alpha is the return you get in excess of the CAPM return. You see this here? Alpha is the expected return on the portfolio, which is in excess of the return that the CAPM states you should get. So if the return you calculate by CAPM for a portfolio A is 10%, and the return that you expect from portfolio A is 12%, the alpha from portfolio A is 2%. Alpha is the excess return that you're able to earn, okay, over the CAPM return. So what was CAPM telling us? CAPM was telling us what should be the return on this particular stock for the risk that you're taking in this stock. If the CAPM return is 10%, but the expected return on the stock is 12%, your alpha is 2%. So remember guys, alpha for the purpose of your FRM, alpha has multiple interpretations. Alpha for the purpose of your exam is expected return on the portfolio minus the CAPM return. That is the return on the portfolio that exceeds the CAPM return is alpha. As simple as that. Is that okay, guys? Have you heard the term tracking error?
No, sir.
No, sir.
Anybody?
No, sir.
Okay, so let us say you're investing in an index mutual fund. What does an index mutual fund do? Let us say you're investing in an index mutual fund that tracks Nifty 50. The mutual fund is not going to be actively trading. It means the fund manager is not going to buy and sell stocks. Whatever 50 stocks comprise the Nifty 50 index, the fund manager will buy those 50 stocks and keep in the index. So your index mutual fund will track the index. Correct? So an index mutual fund aims to give you the return of the underlying index. If the underlying index gives you 10%, the index mutual fund will try to give you close to 10%, like 9.8, 9.9% returns. If the index gives you good returns, the index fund will give you a good return. If the index gives you a poor return, the index mutual fund will give you a poor return. The important thing about an index mutual fund is that because it is passively managed, there are very little transaction fees. There is very little management fee because the fund is not actively managed. Whatever the index holds, the mutual fund holds, right? So there's no active stock selection happening. Now, tracking error is the difference between the return on the portfolio and the return on the index or the benchmark. So let us say we have an index mutual fund which is called, in India, let's say we have a BlackRock Nifty 50 index mutual fund which tracks Nifty 50. Now let's say the Nifty 50 gives 10% return. The index mutual fund gives a 9.95% return. The tracking error is the difference between the two. The tracking error in this case is 0.05%. Is that okay? By the way, for all of you who've not invested in mutual funds, index mutual funds are a very good place to start. So you should look at index mutual funds. They're very cheap to hold. Okay. Then there is a term, guys, called information ratio. Now, an information ratio is an important ratio if you're trying to assess a manager's performance. Okay, how has a fund manager done? What does it tell us? Information ratio basically tells us what is the excess return. Okay, like as you can see the numerator, the return on the portfolio minus the return on the benchmark divided by the variance between the return on the portfolio and the return on the benchmark. So you basically have the excess return on top divided by the active risk on the bottom. So in both numerator and denominator, we are comparing the return on the portfolio with the benchmark, where compare that with the risk of the portfolio with the risk of the benchmark. You see what we're doing here? We're not just looking at the return on the portfolio vis-a-vis the benchmark. We're also looking at the risk of the portfolio vis-a-vis the benchmark. So that's your information ratio, expected return on the portfolio minus return on the benchmark divided by the root of the variance between the return on portfolio and the benchmark. Now, an important thing for you to note, guys, here is on your exam, you will not be asked to calculate VAR or the variance. You will not be asked to calculate variance. You will be given the variance. All that you have to do is ensure that you have memorized the formula well. All these figures will be given to you. You will not have to calculate variance, standard deviation, and all that. So at the level of FRM, you're not expected to do that. You're expected to know what they mean, and the data will be given to you. We'll try and do some questions on this, okay? Any questions so far, guys?
All clear, sir.
Sir,
Okay.
what does the CAPM tells about?
Okay, so the CAPM tells you what should be the ideal return on this stock for the amount of risk the stock is taking.
Sir, but is expected return and CAPM is not the same then?
Okay, so I'm not sure I followed your question. So CAPM tells you what is the expected return on the stock, correct? Basis the risk that the stock carries and the interaction the stock has with the market. What is the return that you can expect from the stock? So there is an expected return that CAPM tells you that you should ideally get for the stock for the risk you're taking. If you believe that return is being quoted as very low and the actual return can be much higher, you would like to believe that the stock is undervalued. You get it? So allow me to write this down. So what I'm saying here is, if CAPM tells you that the return on the stock should be 12%, but you believe the stock can deliver at least 25%, what does that mean? That means in your view, the stock's return will be definitely higher than what the CAPM return is quoting, which means the stock will definitely give higher return than the risk you will take on. If you get a 12% return on the stock, by the way, 12% means 12% is the return that you should expect from the stock for the risk that you're taking in the stock. Okay. If you get a return higher than 12%, you should feel that the stock is currently undervalued. I should invest in this stock because it's going to give a reward which is greater than the risk. Is that okay? So CAPM is just one way of arriving at what return you can expect from the stock. Okay. And
Actually, I got confused when that alpha formula came, because the formula was CAPM minus the expected returns.
Okay, I get it. Okay, so that alpha formula basically is what is your expectation of the return as an investor. So if the CAPM return is 12%, but you expect the return on the stock to be 20%, then the alpha you expect is 8%. You expect the stock to outperform the CAPM return by 8%.
Okay, thanks.
Okay. And then guys, the last ratio here is our Sortino ratio. Sortino ratio, what is it? It's similar to the Sharpe ratio, but there are two basic differences. You remember you had the Sharpe ratio, you had the risk-free rate in the numerator in the Sharpe ratio. It is replaced by T. T is the minimum acceptable return. So if you are an investor and you say that my minimum acceptable return is not the risk-free rate of 6%, my minimum acceptable return is 10%, then you should use a Sortino ratio. On the exam, a question that you can get is, this investor has a minimum acceptable return in his mind, and this and that, etc., which is the most ideal ratio for him to consider if he wants to assess risk and reward. Is it Sharpe ratio, trainer ratio, Sortino ratio? Your answer will be Sortino ratio, because the investor has a minimum acceptable return in his mind. Okay. So your Sortino ratio is expected return on the portfolio minus the minimum acceptable return, which is T, divided by, again, you will not have to calculate this denominator. This denominator will be given to you on the exam. It is called a semi-standard deviation. This, what you see in the denominator, is a semi-standard deviation, which measures the variability of only those returns that fall below the minimum acceptable return. So where a standard deviation, as a term, looks at all the returns variability, irrespective of where the returns fall. It looks at all possible variations of the return. This denominator is a semi-standard deviation, which only looks at the deviation in the returns that fall below the minimum acceptable return, because that is what you want to look at. Your concern is not the risk-free return. Your concern is the minimum acceptable return. What is the return that is minimum acceptable to you? The return should not go below that. So that is your Sortino ratio. And again, I don't expect any quantifiable question from Sortino ratio. It's in all probability, you will be asked more of a theoretical question on the Sortino ratio. Okay, so these are 4 or 5 important ratios, guys. You should know your Sharpe ratio, trainer ratio, information ratio. You should know your Jensen's alpha. You should know your Sortino ratio. And this particular chapter is taken care of if you remember these. So you will have to create a formula sheet and just start memorizing these. Okay. Any questions?
So,
Okay,
Yes, go on.
sir, do we need calculator for the FRM exam?
Yes, you do.
Which calculator?
You don't need calculator yet for foundation. You will need a calculator for financial markets and products. You will definitely need a calculator for valuation and risk models. You will definitely need a calculator for quantitative methods. So yes, you need a calculator. If you don't have a calculator, you cannot clear your FRM.
And which books are needed for the preparation of exam?
Your analyst prep, the access that Zell has given you is good. It has good study notes. It has good question bank. Analyst prep will suffice.
So which calculator? BA2 plus?
BA2 plus Texas Instruments. Yes. Okay, guys.
The normal calculator.
Yes, Tanish. No, the normal calculator is not allowed. You can visit the GAV website. There are 2-3 different types of calculators that are allowed for you to use on the exam. If you bring any other calculator, you will not be allowed to use it. They will confiscate that. Okay. Okay. Om is asking, will I teach Texas BA2 plus? There's nothing to teach in a calculator, but I'll show you the basic functions of the calculator. Don't worry about it. I'll show you those. Because I understand everybody will be new to the calculator. I'll show you how that works. Saurabh, the name of the calculator, Texas BA2 plus. It's a Texas instrument calculator. You can go to the GAV website, or you can also just Google which are the acceptable calculators for FRM. You'll be able to find an entire list of it. I think there are 2-3 different calculators that are now allowed. The list keeps changing, so make sure that you look at that list now. Okay, just Google it or go to the GAV website. You'll know what I'm talking. Okay, guys, we're going to close this session here. We've covered 4 to 5 chapters. I think that's good for a day. I don't want to make it too heavy. We're going to meet again tomorrow at 9 o'clock, and we're going to complete the rest of foundations. All right. And if you have any questions, please park them for me. I'll obviously address them when we have sufficient time. Yes, Rishik.
For today's, what we have learned on quant prep, what are the chapters I need to read? I just want to refer to what we have said. No, I have written down the note. I just wanted to read in theory. So what all chapters are you?
Yes, I'll tell you. So we have covered chapters in foundations. We have covered the first 5 chapters until modern portfolio theory and capital asset pricing model. So we've completed the building blocks of risk management, how do firms manage financial risk, the governance of risk management, credit risk transfer mechanisms, and the modern portfolio theory and capital asset pricing model. We're going to start with the arbitrage pricing theory tomorrow. Okay.
Thank you.
Okay, guys. Have a good day. I'll see you tomorrow.
So,
yes, go on.
I wanted to ask you that all these topics I can get on analyst prep, right? Notes for these topics.
Yes, in case you do not have access, you'll have to contact Zell, whoever is your academic coordinator. They'll give you your coordinates to get that access. Analyst prep has notes for you and a question bank that will suffice.
So I'll get that on analyst prep. That's it. Now I have already enrolled in it.
Yes, you will get that access.
Cool.
You'll have to contact Zell if you don't have that access yet.
Okay, sir. Thank you so much.
Thank you. Thank you, guys. Have a good day.
Thank you, sir.
Thank you. Bye.
Thank you, sir. Bye.
Bye. Bye.